broadcasting live from the CNBC-TV18 Motilal Oswal studios in Mumbai.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. We are coming to you live from the CNBC-TV18 Motilal Oswal studios. I'm Prashant. With me, my colleagues Nigel here in the studios with me, and Sonia is out there all the way in Delhi. Sonia, hi, morning. Nigel, morning.
Morning.
Hi, good morning, Prashant. Good morning, Nigel. So everyone's talking about election jitters, right? I thought, let me come to Delhi and see what the big fuss is all about. No, I'm just kidding. But yeah, I mean, it has been really tricky for the market last few days. But let's see, we have a long day ahead. Nigel, morning.
Morning, Sonia. Well, Prashant, let's get straight to the action then.
Absolutely. Let's get straight to the action. And, it was looking bad. It was looking, no other way to put it. It was looking bad yesterday. The Nifty broke through multiple supports. And, we've been saying this from the beginning of this week, of Monday onwards. That this is not global. Globally, things are looking much better. This is very much a local issue. And I remember on Tuesday morning saying that there is this, almost a slow burning kind of an idea that maybe the prospects are not as clear-cut, as thumping as many were making out to be as far as elections are concerned. So maybe that some of that worry, of course, is showing up in a more pronounced kind of a way. I just start with, I don't usually refer to flows, but because the numbers are so large, I'll kind of start with that's the data set. So FIIs yesterday sold about 7,000 crores worth of stock, nearly 7,000 crores worth of stock in the cash market. That's a large number, right? I mean, locals, they bought about 5,600 crores in the month of May so far, and the numbers really add up. I've just taken the exchange rate from yesterday. That number in dollar terms is 2.75 sell for FIIs, and for locals, that's $2 billion which of inflows. This is dollar billion numbers, and these are some really large numbers which have come through just in the course of May so far. FIs, of course, have been selling before that as well, but it's kind of intensified this month. And we're just kind of sort of still in the initial part, 10 days into May. The F&O position, FIs and what they're doing in index futures has also seen a bit of a dramatic change. So from day before yesterday, as of yesterday's close, FI net shorts in index futures has jumped almost 50%. That's now nearly about 1.57 lakh contracts. You get to about 2 lakh, 2.5 odd lakh contracts, then you start to get to an extreme, and then you start to wonder whether this is it, and the market has got perhaps a little bit of shorts in the system to support any bounces, etc., which may start to come in. But we are, of course, we're getting to that, a big jump that we've seen, as I said, in trade yesterday. The global picture, I mean, for what it's worth, really, and I think you'll have to put it that way because it's not mattered. The S&P is up 0.5%, the Nasdaq is up about 0.25%. The dollar index was down 0.25%. The USD 10-year was down 4 basis points. Oil prices, they rose, and they're at about $84 per barrel mark. That's the Brent oil prices. As I'm saying again, and I repeat, the issue is not global, it's not yields, it's not dollar, it's not the Fed, it's not rates. It's basically local politics and, of course, the election result, which is only, of course, due in the first week of June. Just circle all of this back after what we've done in the market. Just from this Tuesday, where we left off this Tuesday, we're down. Actually, from Monday's close, we're down almost 600 points, right, on the Nifty. So where does it leave us? The support for the Nifty is from from the trend line, which is a rising trend line from the lows of January, and the chart is up on your screen, which will illustrate that point amply. So what I've done is, this is the Nifty daily chart. The start of this particular trend line is January lows, which is 21,137. The next touch point is in the month of April, which is 21,777. And as of yesterday's close, we basically got to 21,932. The support is 21,930. So we are actually at a very, very critical support level. In January, in April, from these levels, the market did see a decent bounce. Hopefully, third time lucky, right? And you are in a position after the sell-off that we've seen. The uncertainty still will continue, and no one knows till we know. That is in the first week of June. But you're at a critical support level, and we'll need to see if that gets defended. If that gets defended and you get a daily positive close, then we can start to talk about higher levels. What are those levels for the Nifty on the way up? Levels are 22,218. These are very near-term levels. That's the 20 hourly, and then 22,300 plus, which is the 40 hourly exponential average. Now, on the Nifty bank, the similar kind of supports, not from the lows of January, but from the lows of February. And it's again on a rising trend line that stands at 47,230. Again, very close by, about 250 odd points away from where we left off yesterday. Hopefully, I mean, we are at that level, at that point where, I mean, some of these levels start to get respected. I mean, and of course, the extent of the bounce from there, we'll have to see. On the way up, levels here at the 20 hourly and on your screen, 48,026. And then the 40 hourly exponential, which is about 48,310. As I say, as I always do, all in the vicinity, nearby kind of levels, because of course we are looking at this on a day-to-day basis. There is a bounce, which is about 50 odd points, which the GIFT Nifty is indicative of. I think, if you get that kind of a bounce, at some point there'll be sort of one leg down, and then, it's possible that you start to find some support, find your feet, although it may take a few days for us to really decipher the trend in any meaningful way from here. Sonia.
Absolutely, Prashant. I think the moot point is that there's no real reason to panic at the moment, right? There's definitely caution in the system, no two ways about that. I mean, all the cues are indicating that there could be some more downside for sure. The Nifty is at a 2-month low. It closed below that 22,000 level yesterday. This is the first signs of major selling for sure, but this comes on the back of a 13% rise that the Nifty has seen in the last 6 months. It's been a relentless rise on the upside, and this is the first signs of a pullback, which is routine in any kind of market up move. Now, the thing is that I think the best thing to do is to wait and watch, because there is definitely election jitters. The counting days on the 4th of June, you could get a lot of volatility. The India VIX has been spiking up as well. All of that put together, definitely some caution, but no real reason to panic, I would think. The one thing that's working in our favor, okay, I'll come to that, but before that, there is large FI selling, as you can see on your screen. In the month of May so far, almost 23,000 crores has been sold by FIIs. But the one thing that's working in our favor is strong global cues. So if you look at it yesterday as well, right, the Dow rallied for 7 straight days, and yesterday the Dow saw a 330-point rally. So the best thing to do is to wait and watch, not get too carried away with emotion or sentiment. Yes, there could be some more downside, but that's also something that's routine in an uptrending market. Having said that, some stocks to watch out for. Today you have lots of results coming through. There is Tata Motors, Eicher Motors, Cipla, a couple of capital goods names as well. So we'll keep our eyes on that. And I'm also looking at SBI. After the very strong showing, there are multiple upgrades that have come in on SBI. So Nomura, for example, has raised their target price to 1,000 from 825 earlier. So I'm also going to watch out for SBI this morning. But Nigel, there's a lot that's going on in this market. And of course, volatility has been on the rise too. What are you picking up?
Well, the fear is that India is decoupling from the global markets because the Dow's on a 7-session winning streak. But I'll tell you what, that's not the case. We're waiting for a big political outcome, and that's why, in fact, there is some kind of uncertainty. Why the market's seeing selling pressure, particularly yesterday? The institutional net sell number continues at around 1,000 to around 1,500 crores. So the DI and FI number put it together. Yesterday, the expiry-related factor as well that did play out. And the 20 DMA, that's got breached in both the key indices. That's the Nifty as well as the Nifty Bank. Just want to make one point out here. Yes, we have seen a bit of a correction of close to around 800 points on the Nifty. But this fall that we're seeing, even in the broader markets, it's coming actually on relatively lower volumes. Because the average volumes this week so far is around 1 lakh odd. The previous week it was 1.22 lakh odd. So the fall is not coming on very, very large volumes. And in case, the outcome is positive that the markets are working with, that the BJP gets another term, then the bounce as well could be as sharp. So just keep that in mind. This fall has come on low volumes. The India VIX, we've been highlighting this. It continues to spike up. It's up for the 11th straight session. And you're expecting more of the same getting into the election verdict as well. So that's another factor. We saw this in 2019. And currently, I'm still leaning that we'll see a repeat of 2019. That sees some selling pressure. The VIX spikes up. And post the outcome, all of that reverses as well. What did the FIs do yesterday? They added close to 65,000 short contracts in trade yesterday, which took their short positioning to around 67%. And that chart should come up for you on the screen. Now the net short positions are around 1.56 lakh contracts. But just want to alert our viewers, it's not a like-to-like comparison. You'll say that it's already at 1 lakh contracts, go in there and buy. Want to make this point that the contract size itself changed on the Nifty. The Nifty contract size came down from around 50 to around 25 approximately. So that's why, in fact, this 1.56 lakh contracts effectively is around 75,000 contracts. So just keep that in mind. We're not yet at that 1 lakh contract mark, which we normally look at. And the gross positioning is telling you the picture, because currently there are 4.5 lakh contracts, the gross. That's the buy and the, the short, long and the short contracts put it together. Normally that number is around 300,000 odd. So that itself is telling you it's because of the contract factor, the change out there. That's why it appears we're at around 1.56 lakh contracts, but actually we're at around 75,000 contracts. The Nifty Bank, if we need to bounce, it needs to come to the party. It's down 5% just in the last few sessions. 7 straight sessions, it's under pressure. SBI's numbers were good. HDFC Bank has reached a crucial support zone. So that one needs to bounce for the Nifty as well to sustain it. So let's pull up the levels you're looking at on the Nifty Bank then. The 20 and the 50 DMA, they become the near-term resistance levels. We're very close to the 50 DMA. The 20 DMA is going to be important. And on the downside, the 100 DMA, 47,200. The Nifty, the PCR is at around 0.9 odd. Yesterday, one contract got expired, so I've not included that. It's holding at around 0.9. And the effective levels you're looking at, the swing low becomes very, very important. That's in April that we saw. 21,778. That's the crucial level. Resistance is up for you on the screen. So if you're an adventurous trader, and if you see that Nifty, at some point of time sees a bit of a dip, you look to get in, you keep your stop loss, you're, out there and hope for a bit of a bounce. The Nifty Bank is a crucial one in today's session, Prashant.
Well, absolutely. And, we'll sort of have more on this as we go along, because there is a lot to discuss. I mean, the big headline, of course, what is happening in the market itself, even as we sort of get through the earnings season now. Well, let's get you some money market views here. On the rupee, this is Lakshman and V of Federal Bank, who says that feeble employment data prints in the US have weighed on the dollar index, and thus all peers traded higher versus the USD yesterday. The dovish Bank of England is now inching closer to the first rate cut since 2020. The rupee traded in a very narrow range yesterday, but should be supported by dollar index weakness. He expects the USD INR pair to trade in a range of between 83.35 to 83.68 to the dollar in the next few sessions before US CPI data that is due next week.
All right, and on the bonds, Lakshmanan says the government bond yields traded marginally lower, tracking US peers. As there were no significant domestic triggers, weaker than expected economic data from the US has raised the odds of rate cuts by the Federal Reserve this year. Markets now await the US and India inflation numbers for April. In the coming sessions, he expects the 10-year benchmark bond yield to trade in a range of 7.08 to 7.18%.
Okay, all right. Well, I think we can run you through all the top 10 stocks that we're looking at in today's trading session. Let's run you through the list. BPCL, SRF, Max Life, about India, Survey, Small Finance Bank. All of them will be reacting to positive news flow. And we're split down the middle. On the negative side, you're looking at Escorts, MGL, HDFC Life, SBI Life, and ICICI Pru.
Okay, well, we've got our first opinion coming through, and it's a big one. We have Nathan Sheets, Global Chief Economist at Citi, who's with us. Mr. Sheets, great to have you with us here. Good morning. Appreciate your time here. All eyes on, of course, the election outcome here in India in the first week of June. I mean, if you've had any interactions with investors with regards to India lately, I mean, would be great to hear that feedback. What's the view, really, which is forming around this one?
I'd say two key observations. First, on the election, I think amongst the investors that I speak with is pretty much a broad view and a broad conclusion that Modi will be successful in this election. If somehow that were to fall short, I think that would be, from the global investors' standpoint, would be a very big surprise and an adverse shock. So that is something we're watching closely. But more broadly, I think we're seeing global investor sentiment toward India, frankly, about as positive as I can recall over the course of my career. And I think that a lot of that is a reflection of anxieties about the geopolitical situation and the relationship between the United States and China. And I think there are a lot of money managers and a lot of corporates that are saying, well, if we're not going to be as intensive with China, where else can we go? And I think that particularly in the investment space, that India has been a winner in that rebalancing away from China.
Nathan, hi, good morning, and thanks for joining. And I want to come back to that point you made earlier about how global watchers are very keenly looking at the BJP-led NDA's dominance in the elections this time around. But if that does not play out, would that reduce your investments or interest in a market like India, if there is some policy instability?
I think it would. And one of the things about the Modi-led government is that investors are familiar with his policies and comfortable with his policies. And it would be a period of evaluation as to what another government would look like and what its emphasis would be. So I think a major barrier is just kind of the familiarity with the Modi government and where we've been. And if things were to pivot in a different direction, as with any country, there would be a period of evaluation by investors. And then ultimately that new government would be judged by what does it stand for, what's it seeking to do, what are its policies.
All right. Hi, Nathan. Good morning and good to see you in. So we'll wait for the political outcome out here and then we get a better sense in terms of direction. But what about the Chinese economy? How are you reading that? In terms of a market performance, that's a bombed out market. And that's why it's relatively outperforming us. But they've been making some moves. The central bank out there, we hear various sound bites as well coming out of them. How do you view the Chinese economy and how does it compare, at current levels in comparison to what India is doing? Because India has been the rank outperformer.
My sense is that the Chinese economy, say over the next 12 to 18 months, is likely to do okay. They've announced a growth target of around 5%, and I think that that's a plausible outcome for China during the coming years, somewhat softer than what we're expecting for Indian growth in 2024. But the key point with China is that when I look out 3, 4, 5 years, I see a lot of challenges for President Xi and the Chinese authorities, from debt and leverage in the economy, aging demographics, big questions of where future growth is going to come from. They're trying to rev up their export engine. But then the question is, well, is the US, is Europe going to open up its markets to China? And then finally, as I've alluded to, I think the geopolitical realities and the tensions between the United States and China more broadly are a major headwind to the Chinese economy going forward. So looking at a 10-year trajectory and a 10-year horizon, I think I like the outlook for India a lot better than I like the outlook for China.
Nathan, just one more point since we're talking about the globe. When we chatted the last time, you were expecting rate cuts in the second half of the year, and that's most likely to be the case, if at all any. How many are you factoring in now?
Well, I have to confess that as the year has progressed, the number of rate cuts that I've expected for this year is being reduced. That there's just no other way to put it, that for the U.S., Q1 inflation was just a dreadful upside surprise. It was a veritable nightmare in the first quarter on the inflation front for Jay Powell and his colleagues at the Fed. And I think we've moved from a world where 3 cuts during the second half of the year seem plausible to now where the debate is probably more 1 to 2 cuts. I'm still hopeful that maybe we can get the 2 instead of the 1. But we've got to see better inflation performance than we saw during the first quarter. There's work to do, and I think the Fed's going to have to keep rates where they are for a while longer.
Right, Nathan. Will the global risk appetite for equities remain positive through the year for equities? I mean, in major markets, and of course, US is the driver. Because, rate cuts, it'll happen sometime, right? So that promise is there. When is the question? But that promise also can keep investors excited and sort of looking forward to it. And hopefully the economy will not weaken too much. So it's like weaken a little bit, allow them to cut rates. It's the ideal situation. And that keeps everyone happy. Do you think that's what we're going to see?
I think I'd be cautiously optimistic about risk appetite through the remainder of this year. My sense is that we're continuing to see resilience in the global economy, that the global consumer, broadly speaking, continues to perform well. Spending is continuing in a number of economies at a reasonable pace. And then when you couple that with ongoing rate cuts in a variety of places, we've talked a little bit about the United States. The Riksbank, the Swedish Riksbank, started cutting this week. Our expectation is that the ECB and the Bank of England will start cutting mid-year. So the combination of a resilient economy and some rate cuts from a variety of central banks, both EM and DM economies, is likely to be enough to keep risk appetite pretty solid through the remainder of this year, I would expect.
Okay, Nathan, thanks a lot for joining in. And what stayed with me is your view that from a 10-year horizon, you prefer a market like India over China, considering that China is dealing with aging demographics. And of course, in India, in the very near term, some political volatility cannot be ruled out. Always a pleasure talking to you, Nathan. Hopefully, we'll get to speak to you again very soon. Let's take a quick commercial break on that note. We have many more stocks to discuss on the other side of the break, so don't go anywhere. Welcome back to Bazaar Morning Call. Hope you're having a good morning so far. Well, after the last couple of days, perhaps the bulls are not having such a great morning. But let's see which way things go. Lots of stocks in focus today, so let's get straight to it. First up, BPCL on our radar. Sonal is here to tell us more about that. Sonal, morning.
Good morning, Sonia. Well, it was a good set. Operationally, it was better than what the street was working with. So on a quarter-on-quarter basis, revenues were up 4.5%. EBITDA came in at 9,211 crore rupees, which compares with a poll of 9,016 crore rupees. Margins came in at 7.9%. That's a big growth sequentially. And profits were up 24% as well. Now, GRMs, the reported GRMs they came in at $12.4 per barrel, which is versus the estimates of $17.1 per barrel. So refining was a miss this time around. The refining throughput came in at 10.4 million metric tons, which was higher than what the street was working with. But overall, operationally, it was a good quarter. They announced dividend of 21 rupees per share. For FY24, dividend came in at 42 rupees a share. They also announced a bonus in the ratio of 1:1. Morgan Stanley says that BPCL had the best outperformance in margins amongst the oil marketing companies. Now, all three of them have reported numbers. Jefferies says refining was below. However, margins will remain range-bound going forward. The net debt was also sharply low, 50% down on a YY basis. So they are positive on cash flows and balance sheet going forward.
All right, thanks a lot for that, Sonal. Well, I'm also watching out for Escorts Kubota because the company had a conference call yesterday and the takeaways were not too great. The commentary was quite muted, actually. The company said that they expect the tractor industry volume growth of low to mid-single digits year-on-year for FY25. And they speak about how Q1 FY25 demand continues to be very weak. There are, of course, several reasons for that, which we have documented ad nauseum. Lower Rabi output, impact of elections is something that will hit demand. So they're talking about demand recovering only from August of 2024. Now, they also say how their other segments are doing well. So the construction segment, for example, the EBIT margin at 9.3% is the highest ever that they've seen in this segment, picking up because of election-related construction activity, etc. And the railway segment order book also continues to be quite stable at 950 crores as of March versus 900 crores in December of last year. Now, the capex guidance that the company has given out as well stands at 300 crores. So it's higher capex in FY25 compared to 175 crores in FY24. But I'm going with red because very muted guidance for FY25. They talk about low to mid single digit growth for the full year. But do note that we will connect with the management of Escorts at 9:40 a.m. today to get more details on that. But back to Sonal to talk about MGL and SRF and why she's watching that one. Sonal.
Well, let me start with Mahanagar Gas reported numbers yesterday. While volumes were largely in line with estimates, it was a margin miss. And that's why I'm going with red on the stock. Revenues were flat at 1567 crore rupees. EBITDA was down 12% on a sequential basis. Margins came in at 25% versus a poll of 27%. And profits were down 16%. They came in lower than the poll as well. As I said, volumes were largely in line with estimates at 3.77 MMSCMD. And EBITDA per unit was lower than estimates to come in at 11.48 rupees per unit. So yes, it was a margin miss this time around. For SRF, the company conducted a conference call post-market hours yesterday. They are looking at a growth of 20% plus in their chemicals business with margins of around 26 to 27%. For their packaging business, they said that BOPP is expected to fare better than BOPET. This industry has been facing a lot of supply challenges. FY25 capex could be to the tune of 800 to 900 crore rupees. Also, there was an anti-dumping duty by the US on refrigerant gas. The company says it will not have a big impact on the company per se because the street was nervous about it. Morgan Stanley says the company addressed concerns around demand and margins in its verticals and it is pointing to a gradual improvement in growth over FY25. UBS says they see cyclical bottom for this name and the worst seems priced in. So they have a buy with a target price of 2,700 rupees per share on the stock.
All right, Sonal, thanks very much for that. So we'll keep an eye out on these stocks. But, life insurers numbers, monthly numbers also came through and it's an interesting set as always. Yash has got details here. Yash, good morning.
Good morning, Prashant. So, I mean, if you look at, the month of April on a standalone in an isolation basis, then except for HDFC Life, all companies have performed very well, very strong show in terms of premium growth numbers, APE growth numbers and retail APE numbers. But the game is a little more tricky than that. We need to, take in the base effect which also happened last year in the month of April. And if you do that, then in that case, HDFC Life's premium numbers are very weak. Premium has just grown by about 4.3% on a very favorable base. Total APE and retail APE has grown at a decent pace. ICICI Prudential Life, again, the numbers are weak. If you take in the base effect, the premium still growing at 28%, but still would consider it weak. Total APE and retail APE numbers are strong for ICICI Pru as well. Max Life numbers are stronger even after taking the base effect, and the retail and the total APE numbers also look strong for the company in the month of April. SBI Life numbers, the base was favorable, but still the numbers have done decently well at 26% growth on SBI Life. Total APE and retail APE numbers have been strong. And finally, LIC. LIC has seen a growth of 113% in premium in the month of April after factoring in a base effect of negative 50% in the month of April last year. The numbers still look strong for that life insurance giant.
Okay, thanks Yash for that. Well, let's hop across to Upasana, who's joining back on the top 10 segment. Hi Upasana, welcome back and run us through the stocks you have on your radar.
Good morning. Thank you so much, Nigel. Now, first up is Abbott India. The company has reported its Q4 FY24 numbers and a good set, must say. The revenue is up about 7% on YoY basis, and EBITDA margins have expanded sharply, almost about 100 basis points from 21.9% to 22.9%, while the profit is down about 8% at 287 crores. While it is important to note that the company has declared a final dividend of rupees 410 per share. Next up is Suryodaya Small Finance Bank. The company has reported a healthy business momentum with disbursals up almost about 39% on YoY basis. NII saw an uptick of almost 29% on YoY basis, and PAT also saw an uptick of almost 56% on YoY basis. While the asset quality of the company has also improved, with GNPA ratio at 2.9% versus 3.06%, and an NPA ratio stood at 0.8% versus 1.4% sequentially.
All right, thanks a lot for that, Upasna. Appreciate it. So lots of stocks in focus. Here's a quick recap of our top stocks. The stocks with positive news flow: BPCL, SRF, Max Life, Abbott India and Suryodaya Small Finance Bank, while stocks with negative news flow: Escorts Kubota, MGL, HDFC Life, SBI Life, as well as ICICI Pru. But let's go across to Manisha Gupta today to get us a quick roundup of all the action from the commodity markets. By the way, today is also Akshaya Tritiya, so it's that auspicious day when you go out there and buy some gold. Manisha, hi, good morning. Happy Akshaya Tritiya to you. And what is your advice and what is actually happening in the commodity markets now?
Thank you for that, Sonia, and a very happy Akshaya Tritiya to you. I mean, from whatever I've been speaking to the industry, jewelers, they do expect a good amount of increase in value, not so much on volume, though they're anticipating a 10% decline with the way the gold prices have continued to run up. Overnight as well, we've seen the gold prices gain. The prices are up 2% in this week, with the Bank of England signaling a cut coming in the month of summer. The U.S. jobless claims are higher than anticipated at an 8-month high. So you have seen a surge in markets betting on a 69% chance of a rate cut from U.S. Fed in the month of September. Now, all of this clearly seems to be supporting gold, and not just gold. Platinum is trading at a 4-week highs. We saw silver prices gain up by 3.5% overnight. And with this kind of data that has come in, we've seen the U.S. dollar kind of soften, and that has supported other commodities also. So we saw copper prices gain up by 1.5% overnight. Crude prices from a level below 82 in this week itself are now trading at 84.5. So smart jump coming in for crude oil prices also. So Asia is a market where I'm looking at most commodities trading in positive.
All right, Manisha, thanks very much for that. That's oil in focus, and it's crawled up to about 84 plus or so right now. We'll take a quick commercial break here. We have Guru Prasad Srinivasan, Executive Director and Group Chief Executive Officer, and Kamal Pal Poda, Group Chief Financial Officer at Quest Corp, and they join in to discuss the company's fourth quarter performance. Stay tuned.
Welcome back. You're tuned into Bazaar Morning Call. Well, let's get you, some bites coming in from the SBI management. Remember, the bank yesterday delivered a very, very strong showing in the fourth quarter. My colleague Ritu Singh spoke to Mr. Dinesh Khara, the chairman of the company. Let's listen in to what he had to say.
We'll continue to monitor the capital requirements, and also the factor that our ROE is much more than that of our loan book growth. So that also is self-accretive as far as the capital is concerned. If required, we will look at the capital raise, but otherwise we should be in a position to support it with the plowback of the profit, which we have been doing for past couple of years. Well, the slippages were essentially seen in agriculture and SME, but I would also like to mention about out of this 3,886 crore worth of slippages which happened in the last quarter, we have already pulled back about 886 crores. So I think I don't expect that it should be any more a challenge. But yes, of course, nevertheless, we'll remain vigilant and ensure that we maintain a tight control on the slippages.
Well, let's talk a little bit more about SBI. Siddharth Khemka, the head retail research at Motilal Oswal Financial Services, joins us on the show. Hi, Sid. Morning, and thanks a lot for joining in. Well, it appears SBI has strong cushions this time around to protect the bank from any kind of shocks, and also has adequate capital this time for growth. Now, the ROAs are more than 1%. The ROE is at around 17%. Is it still well placed after the kind of run that we have seen this year?
Yeah, hi, very good morning, Nigel. Glad to be on the show. So if you look at SBI has been consistently delivering in terms of results as well as Q4 numbers have been pretty strong. The PAT grew 24%. It has a 28% beat with our estimates, mainly driven by higher other income, lower OPEX, and more importantly, lower than expected provisions. We saw some of the PSU banks where provisions and slippages were higher than expectations, and hence there was some concern whether SBI could also see an increase in provisions, but that was not the case. NII was up 3%. So I think overall, if you look at SBI has made a swift recovery over the last few years, and the cumulative profits of the last 3 years have been equivalent to what the company had earned in the previous 20 years. So that is the kind of growth that the bank has seen. And with the economic growth, and especially the corporate side, lending side, seeing the kind of recovery, we believe SBI is well positioned to deliver steady earnings. The key question here is what kind of valuations you give to such kind of steady earnings growth company with a decent ROEs, improving ROEs and ROAs. And you can clearly compare it with the likes of some of the larger private sector banks, like the likes of Axis, which currently trades at 2 times forward, while an SBI is trading at 1.5 times 1 year forward. So we are definitely very positive on SBI. We believe that the discount SBI trades to some of its private peers is no longer warranted. With the consistent delivery and the strong earnings growth trajectory, we believe there could be significant upside and re-rating potential within SBI. So right now we are valuing it still at about say 1.4 times on FY26 basis, which gives us a target price of 925. But we are internally discussing whether that discount could narrow down in future going ahead.
Okay, in fact, many brokerages have gone ahead and raised their target price on SBI post the numbers, right? Nomura has raised it to 1,000 rupees. Morgan Stanley has raised their target price to 800. I mean, SBI has already crossed that, but most of brokerages are upbeat there. Siddharth, hi, good morning. I wanted your thoughts on Escorts, because not only were the numbers weak, the revenues have actually fallen, but the management outlook is also quite muted. They talk about low single-digit growth for the sector. The tractor industry, would you be cautious now, or do you think it's a good time to buy the dips?
Yeah, Sonia, good morning. So I think the industry volume growth had been highlighted in the previous quarter itself, where both M&M and Escorts had clearly given a mid-single digit kind of growth guidance for the industry. The good part is that with the expectation of a good monsoon, recovery is something that we are expecting in the H2. Nonetheless, in the near term, I think with the ongoing elections and the slow movement demand in the rural side, I think the Q1 numbers would continue to remain weak. And post the monsoon and the elections, I think there could be some pickup in the tractor business. Nonetheless, very weak outlook by Escorts. I think the near-term outlook doesn't look that constructive even for the full year. We would see that the expectation is not that strong for Escorts, and the valuations are at very high. So within the, if you were to play the rural theme and the monsoon, I would prefer an M&M where you also have the passenger vehicles plus the tractors. And we would look at some of the two-wheelers, for example, a Hero Moto, which kind of get a very good number. Valuations are comfortable, and they are best suited to play the rural recovery theme.
Okay, Siddharth, just stay on. We have a couple of managements joining us now, so we request you to listen in as well. Let's talk about Quess Corp. Their Q4 margins have improved. The workforce management business has been quite steady. Their headcount has been growing year on year, and general staffing has crossed the 400,000 milestone. So basically, all good things happening at Quess Corp. Guru Prasad Srinivasan, the Executive Director and Group Chief Executive Officer, and Kamal Pal Hoda, the Group Chief Financial Officer at Quess Corp, both joining us now to give us, their view on the business. Gentlemen, morning to both of you. Mr. Srinivasan, I want to start with you. It's the margin improvement that the street definitely likes. I think in FY23 as a whole, your margins were under a bit of pressure because of some decisions that you guys had taken, slowdown in IT staffing, etc. But I want to know from here on, in FY24, your EBITDA margins closed at about 3.6%. What kind of upside do you have in margins going forward, and what could the range look like for the business?
Sure. First and foremost, thanks for having us on the show, and we are delighted to announce our robust result for Q4. Our EBITDA has grown 18% year on year, and our revenue growth is 11% year on year. And coming back specific to question that you asked, yes, our margin had a great uptick during the year, from 3.42 to 3.92, where we exited the Q4 financial FY24. A couple of specific callouts there is one. We had actually informed in past as well that founded one of our product-led business where we had done the investment, and we are happy to announce that we are on plan and our burn has reduced in that business. So that is one of the contributor why the margin expansion is slowly coming back, nearing to 4%. And the other incidents are the IT slowdown that we had, and couple of investments that we had, burn that we had during FY23 has taken better shape in FY24, and that has helped us to narrow down the percentage a bit. Beyond that, there is a lot of operational efficiency and more deep business drive and orientation that we have brought into with more technology interventions, which has helped us to expand our margin in terms of what we offer to our customer in terms of bringing our cost to serve down. So multiple parameters which has helped us to bring it near. I would leave it there.
Got it. Mr. Srinivasan, I take your point. There are multiple, triggers on the upside for the margins. I get that. But particularly for the US staffing and the found IT business, you had spoken about how you're looking for break-even by the end of FY24. In Q3, you had said that. Has that happened, and what is the expectation moving forward?
Yes. So we are, as I said, we are on track and on plan. Year before, we almost burnt about 98 crores, and this financial year we are close to about 60 crores. So the burn has come down, and as we said, Q4 we are almost close to about 6 crores burn. It has drastically come down from where it used to be about minus 20 crores, 27 crores in Q1 FY23. So we are on course, and this year we should almost continue to be break even and invest more in marketing. Our revenues are going up. Our quarterly revenues for Foundit sales have crossed almost 50 crores. And that is going to set the right trajectory for us in this financial year to continue to be almost break even throughout the year and invest more on marketing and focus on sales.
Got that. Sorry, monthly, what is that run rate you said, Mr. Srinivasan?
So Foundit, we clock a revenue of sales of 50 crore per quarter.
Okay. Overall, at a EBITDA level, what was the loss in US staffing and founded in 24? And could you give us an overall could you guide us for FY25?
So, I mean, US is a very small investment, and it's not a major burn. It was about 12 crore, and we are done with it. And if you look at now, we are off completely on that, and we have no more burn. We have scaled down the business completely, considering the economic environment around. But otherwise, this year we will not have any burn, and we are just moving ahead as part of the workforce. There won't be any burn coming out from US.
Okay, all right. Good morning, gentlemen. Give and take everything. Getting back to the first question, what is the margin number we should work with? Q4 looked good. There's been some improvement in FY24 in comparison to FY23. We're looking for a number. Any one of y'all can give that one to us.
So let me take that, Nigel. Yeah. So while we do not give any number guidance, but if you see a large part of our business performance is actually linked to the strength of the growth of the economy. And with the investments happening in infrastructure and utilities, which are high employment intensive sectors, we believe that we should be able to grow at least 2 to 3x of the GDP growth rate.
Okay, and margins could you hold around these levels?
Definitely. We would love to actually expand the trend of expansion in margins. We'd like to continue that in next year.
Yeah, because the cash burn is going to come down in this couple of these businesses as well. So obviously the margin should look up. Maybe around 20-30 basis points better than what you did in last year or more?
Yes, it should be.
20-30 basis points we're working with, right?
That's right. Yeah.
All right. Which verticals are likely to drive hiring in FY25? Any kind of guidance you can give us on the headcount addition that you're looking at in FY25 for the staffing business?
So just to add a bit more flavor to it, Nigel, I think, country is in the phase of investment, and I'm sure we'll have much more firmer view post-elections. And our business is directly reflecting the country's economic growth. So, I mean, we are in a space where we are highly intensive in terms of, where human capital is, and the investments are getting into utility manufacturing and infrastructure. So all our three businesses, we would still continue to see a kind of outlook anywhere between 18 to 20% revenue growth that we'll still anticipate, the kind of demand that we are seeing coming in specifically for workforce. And our GTS business continues to deliver a higher EBITDA margins. And of course, the third platform, which is integrated asset maintenance, has come out of all COVID holdbacks that it had, and steadily delivering their results and also delivering a quality EBITDA margin. So from that standpoint, I think we'll continue to, we are quite confident to see anywhere between 18 to 20% growth.
So this GTS business, the revenue growth year on year has been about 5 to 6%. Can you push to double-digit revenue growth anytime soon? If yes, what are the timelines looking like? Mr. Srinivasan?
So we would definitely want to go that direction for that business, obviously considering the kind of quality of EBITDA that we get. But it has a two set of mix of business that comes into international as well as domestic. The international business comes at a very higher EBITDA margins, but the quantum of that mix is to the revenue will not be as high as it would be. It would release a healthy EBITDA margin, but not a higher revenue growth, which is what you can see the non-linear growth, the way this business is growing. So we anticipate we'll bring in the right mix of both as part of our plan. But yeah, very close to a double digit is something that we should definitely, aspire at.
Got that. Thank you very much, both of you, for joining us and running us through some of that detail and how F525 really looks like. Appreciate it. Quest Corp and focus there after numbers and that management interaction. But we're sort of focusing back on the market. 12 minutes to go for the pre-open session. Anuj is here with what he's watching. Anuj, morning.
Morning, Prashant. Well, you know what? The market's been quite tough over the last few days, and the biggest talking point has been the India Volatility Index, the India VIX, that is. And what I'm doing is just trying to get some parallels from what's happened in the past. We have seen a sharp rise from 10 to nearly 19, 18.2. Actually, if you see last time when we had this kind of level was in September, October 2022. And what happened back then? The Nifty fell almost 6% from the peak. And after that, of course, we hit all-time high. The other parallel that I'm drawing to is the 2019 elections. In that, between phase 1 to phase 4, the Nifty fell about 4% from the peak. And then after that, hit a new high. So I think there are some parallels here for the index. And once again, the FI short position that level is reaching all-time high. In fact, if you look at the trade setup, yesterday there was quite a bit of selling in index futures, almost 3,800 crores, and 3,000 crores in stock futures. And within that, quite a bit of selling in both Bank Nifty and Nifty, 1,050 in Bank Nifty and 2,800 crores in Nifty. And you look at the next plate, the long short position from the FI side. Yesterday, 63,000 shorts were added, 2,000 longs were covered. And net, what we have done is now we have reached I think the next plate would show you that we are at 32.9% long positions and 1,56,000 in absolute number. This number was on the long side just a week back. So that's the kind of shorting that we have seen from the FIIs. Of course, this kind of shorting always requires some kind of trigger for covering. We don't know where that would come from, but the put-call ratio is also at 0.71. So ingredients are in place for markets to have some kind of short covering bounce. Coming to levels then, on the Nifty, the first resistance would be 22,185, which was erstwhile support, and then 22,308 to 22,350, the 10 and 20-day exponential moving average. The support, of course, first yesterday's low, and my sense is that maybe we test that today after a gap up because the texture has been extremely weak. And after that, the bigger support is 21,750 to 21,800, which could be a bit of a hard bottom for the market. It was also the April low. So let's see. The market's oversold, but as I said, it needs some trigger to get out of this oversold nature. For the quote of the day, in fact, I leave you with this beautiful plate. Today is Akshaya Tritiya, and to all our viewers and to you, Prashant, Sonia, Nigel, happy Akshaya Tritiya. It's said that, you know, if you buy anything good on this day, you normally never lose money. So all the best for fresh investments.
Absolutely, and same to you and your family, your team as well. Anuj, just one quick point on that VIX, right? I mean, which you were mentioning earlier. And you were sort of making that parallel with 2019. I mean, just a thought. I was looking at the VIX chart. Back then, it went from, I think the high was about 24, 25 or something, right? It went from 8 to those kind of levels.
Exactly. I think so.
And this time also we've come up to 18 now, right? The point is, we've in percentage, you know, should one look at the level, absolute level, or the percentage rise? Because the percentage rise is pretty large.
Yeah.
But in terms of absolute levels, we are still some distance away. Maybe we get there as we get closer to the elections.
Absolutely. I think, Prashant, you know, you've hit the nail on the head. I think that's the call that, you know, one needs to take. Also because what is different between then and now is this time we have a macro event. I think back in 2022, it was not really a macro event which was impacting the India VIX. This time, the India VIX has risen purely because of the impending election. So I think, again, you know, who's to say this stops out at 22, 24? Even that FI short positioning, we don't know where it actually bottoms out. So that's why it's always tough to predict the last 400, 500 point of Nifty fall.
Just one more word, Anuj, on the net short positions. You know, that 1.5 lakh contracts, this time the lot size has changed as well. So effectively, it could be 75, 80,000 contracts.
Absolutely, Nigel. So percentage-wise also, we are at almost 32, 33%, I think. So the bottom has been actually 11%. But even in percentage terms, normally 25, 30% is what we bottom out at.
Okay, all right. Thanks a lot for that, Anuj. Well, let's slip into a short break. Up next, we'll have Srikanth as well as Mitesh who will be joining in to help us out with some technical trades. Stay with us.
Okay, welcome back. You got the market open, the pre-open coming through in a couple of minutes from now. Let's get in our technical analysts. Mitesh Thakkar and Shrikant Chauhan are with us. Gentlemen, good morning. Good to have both of you here. Thanks very much. Will it be a good morning, though, is the question from a market point of view. Mitesh, you know, and we'll put the chart up for our viewers. You know, the low in January, the low in April, and the low yesterday, almost kind of similar. In January and April, we got decent bounces from those levels, which is where we left off, 21,930. So there you go on your screen. I don't know if you can see that. So is that a point where we will see a bit of a reversal? Or we go to the April lows, 21,777. Mitesh.
Morning, Prashant. They can go even lower. So I think, what has happened. I think what has happened is that, we sort of kind of got what I would call is not a very classic double top because the closing was slightly up and down. But on an intraday basis, we had a high of 22,775 on the 10th of April and a high of 22,783 on the 30th of April and a high of 22,794 on the 3rd of May. So multiple tops around this 22,750, 800 zones. Looks like a irregular double top. And yesterday we kind of broke a rising trend line, a couple of modified averages and some indicators on the weekly basis turned south, suggesting that the medium-term direction is slightly turning negative. So I would definitely look at 21,777 and 800 levels, which was my earlier support area. That's the one level. But there's a good chance that we might hit the weekly averages around 21,650, 600 zones. And if we break that, which is also a possibility, then we might even go lower. So the idea is that this market has turned slightly negative. I think sell and rallies could be the texture in the next 1.5 to 2 weeks. And getting past 22,200, 250 would be very important for the market to negate this breakdown kind of a setup. So in the short term, it's a negative view.
Okay, short term, there is more negativity in store for the market, perhaps more downtick as well. Shrikant Chauhan is joining in. Shrikant, what is your view? Do you think there's lots more downside in store? If yes, what's the best way to approach it now? Does it make sense to take a fresh short position at any point?
Good morning, Sonia. Good morning, everyone. Well, for Nifty, we feel that it is heading for the next levels of 21,700. And if we see the entire pattern of last almost 4 months, then whenever the market has fallen to 21,700, on a closing basis, we saw a smart recovery in the market. Currently, the markets are completely oversold and most of the stocks, most of the indices are very close to their important support levels. So till the markets are not closing below the levels of 21,700, I am of the view that we should not be overly bearish at current levels. Yes, in case if there is any rebound from current levels, then close to 22,200, we should look for taking some short positions in the market, but with a tight stop loss at 22,300. In case if we see the market is not breaking 21,700, but if it crosses 22,300, then again it will be a trend reversal formation for the market. So at these levels, it is better to take some contra view in the market. FIs are heavily short in the market. So in case if there is any reversal because of any reason, then we could see sharp short covering in the market. So 21,700 should be the final stop loss for creating any long positions in the market. And for the Bank Nifty, there also we saw good amount of consolidation whenever the Bank Nifty has fallen to 100-day simple moving average. So broadly, we are of the view that at these levels, it is better to take some contra view in the market.
Okay, let's do one thing. Let's take a short break. When we come back, we'll have the pre-opening rates. We'll also talk about individual stocks. We'll also connect with Probal Sen, the research analyst at ICICI Securities, to put focus on the oil and gas sector. Stay tuned. Welcome back. As promised, we have our technical guest telling us about what are the stocks that you should be picking up today, or rather what you should be avoiding. Mitesh Thakkar, Shrikant Chauhan have been sitting by. Mitesh, what do you do with individual names now? And what about stocks like, say, an SBI, right, where numbers are good? Would you advise buying the dip?
See, there can be selective buying, yes, despite the fact that I have a negative view, but I have a mix of buy and sell calls for the time being. The idea is very clear, we are in a situation where the markets might correct. That's a strong possibility, and therefore we'll take with some negative bias. I have a mix of buy and sell, as I said earlier. On the buying side is FMCG names like Britannia and HUL. So Britannia, HUL is a buy with a stop at 22.97 for targets of 23.80, while Britannia on a mild dip, say around 50.50, buy with a stop below 49.90 for targets of 5,200. And on the selling side is DLF looks corrective, could extend the pullback. So look at targets of 800 and use a stop at 851 here. And Indian Hotels, similar pattern. That's a short-term sell with a stop at 561 for targets of 530.
Got it. Thanks, Mitesh, for that. Shrikant, what about you?
Good morning, Nigel. I think, two-wheeler stocks are really doing well. And yesterday, there was good amount of buying attraction in almost all the two-wheelers. But in that specifically, Hero Motor looks really good. It is crossing its consolidation zone. And based on its formation, I think it is heading for the levels of at least 5,000 in next few weeks. At current levels, 4779, 4780, it's a buy with a tight stop loss at 4650 with a target of 5,000, 5,050. And the other stock which we like is TCS. And there also we saw reversal formation in yesterday's trading session. There was a good amount of selling pressure in almost all the indices, index heavyweights, but this one did really well. It was around 3950 levels yesterday. From here, the stock can go to the levels of at least 4,050 or 4,075. So TCS is also a buy at current levels with a stop loss at 3900.
Okay, thanks a lot for that. Well, let's go across to Sneha Seth, the derivatives research analyst at Angel One, joining us now. Sneha, tough days for the market, but what are you seeing in the F&O space and what are the individual stocks to look at today?
Very good morning, Sonia. If you look at the market, yesterday's close below 22,000 mark wasn't that encouraging. In fact, I believe we may see some further selling pressure coming towards, 21,700, 750 odd zone. On the higher side, I believe 100, 200 should be acting as a resistance, and any bounce back towards those zones, someone who is stuck with their long positions should think of exiting their positions there. In individual counters, I have a 2 sell call. If you look at Tata Power, so this counter corrected nearly 5% yesterday. After quite some time, it has reached the 20 DEMA on the daily chart. So I believe we may see follow-up selling coming in this counter. So I would recommend selling this counter with a strict stop loss of around 430, and the target expected will be around 387. Apart from this, National Aluminium, this counter again looks good for the sell. This counter again has corrected nearly 4.5% yesterday, and I believe we may see further selling towards 89 EMA. So I would recommend selling this counter as well with a strict stop loss of around 177, and the target expected will be around 157.
Okay, all right. Thanks a lot for that, Sneha. Well, let's hop across to Prashant, who's gone to the wall. He's got something interesting on the Nifty. Prashant, take it away.
Just a quick look at the Nifty chart, right? As they say, a picture is worth 1,000 words. And I thought, why not just kind of quickly tell you. This is the Nifty daily chart, which I've sort of presented in the morning as well. And this is just this year. So very, very recent history. This is January of 24. And I just kind of looked at a this trend line. That's April 21,777, which is the low. And of course, yesterday's big bar down and the candle there, it meets the trend line at about 21,930. The point is, in each of these instances, you look at this, right? The fall is pretty similar, and then from these levels, the market saw a decent bounce. Similarly, in the month of April as well, a bounce almost similar in degree to what we are seeing now, and then a decent bounce, and we are right there. Simple point is, of course, anything can happen and the market can, the levels are there. For example, the low in April was 21,777. So that's the next logical kind of a sort of target that you could look at. But this is as good a place as any if a bounce has to emerge. That's the point that I'm making. So we are at a critical and an important support zone for the Nifty at this point in time. Back to you.
Okay, thanks a lot for that, Prashant. Well, let's hop across to Prabal Sen, who joins us to help us out with some quick analysis on the oil and gas space. Hi, Prabal. Good morning and good to see you. Ben, let's focus on the OMCs first. BPCL, what's your view on the numbers?
I've said this earlier. I must apologize for BPCL and IOCL. We are not allowed to sort of speak since they're on our restricted list. So I can speak on the numbers in terms of meeting. I think both IOCL, HPCL, and BPCL. If you notice, one thing is that the GRM seem to have disappointed the street. One idea could be that the extent of Russian crude advantage probably has reduced to a certain extent, specifically looking at HPCL's numbers where GRMs came in below estimates. Plus, there could be some inventory impact. Their, analyst calls are actually going to be held today, so we'll get more insight on that. But other than that, I think refining throughput and marketing volumes in particular seem to have come in ahead of estimates, and implied marketing margins also seem to be holding up. So to that extent, I would say the results, while a tad below, I think, street estimates across the board for the three, I think the prospects probably appear better, specifically now that the crude prices have started to cool off a little bit. So the pressure on marketing margins will also ease up. While for GRMs, in any case, I think some normalization was probably bound to happen after the kind of levels they have been hitting over the last couple of years.
Okay. By the way, the pre-opening rates are settling right now, and it's quite eerie, actually. It's very quiet. I don't know which way things are going to go, but for now, there's not too much action happening after the big fall yesterday. Let's see whether there is any recovery in store today, but right now, very, very quiet. Prabal, good morning, and thanks for joining in. I wanted your thoughts on Mahanagar Gas. Across the board, it seems to be a disappointment. The volumes were below estimates. Margins are down 350 bips quarter on quarter. What do you do in that stock?
For MGL, what is important, in terms of volumes, to be honest, they were broadly in line, in fact, slightly ahead of at least our estimates. I'm not too sure what the street was looking at. So to that extent, we are not too disappointed with the volume performance. Margins, yes, have come off primarily because the gas costs seem to have come in a bit ahead of what we were looking at. Realizations, I think, are broadly in line with what we were staring at. If you look at FY24 average margins, they still are well above their historical levels. We'll have to understand from the management a bit more in terms of why the gas costs have risen. One of the reasons that has been cited, at least by IGL, to put a parallel, is that the allocation of domestic gas seems to have gone down even further in this quarter. So perhaps that could have been a reason to a certain extent of the disappointment as far as margins is concerned. But more important would be what happens to the margins basically going forward. What kind of allocation is being guided to by the government for the priority sector going forward for the next couple of years, and what kind of contracts do these companies have to mitigate that. So we'll have to get a little bit more insight. Yes, but on the face of it, this quarter has been a little bit of a disappointment from the margin standpoint.
Disappointment from the margin standpoint. ONGC, any thoughts here? Prabal, morning.
Morning. Our view doesn't really change much as long as crude remains comfortably above $75. What happens to the crude prices, hardly really matters. The government has been extremely, extremely proactive in terms of maintaining the windfall taxes at a level that allows a realization of around $75 to $76 for both the upstream companies. So that, I think, creates a little bit of comfort. Gas prices are also broadly fixed for about 95% of the portfolio at $6.5 for this year, going to about $7 for next year. That is also, again, well above historical levels that they weren't. The critical issue continues to remain, how does the KG Basin asset actually perform over the next couple of quarters and indeed the next couple of years. As long as that production growth continues to be in line with what the management has guided, I think ONGC should continue to do well from both an earnings perspective as well as a stock perspective.
Okay, thanks a lot for that, Prabal. Great speaking with you on the channel. Thanks for joining in. So that's the outlook on the oil and gas sector. But we have a large market to trade, and after yesterday's steep fall, one wonders what the outcome will be today. For now, things are looking very, very quiet. Quiet is good. Don't want too much volatility after a day like yesterday. But Mitesh is with us. Mitesh, what's the big call at 9:10?
I'll go with Britannia as a buy call. Look for targets of 5,200 here.
Okay. Okay, all right, got that, Mitesh. Well, let's go across to Sonal. She's here to tell us about SRF. Sonal?
Well, SRF reported numbers day before yesterday, and it was a weak set when it comes to margins. But the management held a conference call yesterday, and in some sense, they did indicate that maybe the worst is over in terms of the inventory destocking that we've seen in the chemicals business. They indicated that the chemicals business will grow at 20% in FY25, and margins will be in the range of 26 to 27%. In the packaging business, which has been under pressure in the last couple of quarters, they said BOPP is expected to fare better than BOPET film segment, and FY25 capex should be in the range of 800 to 900 crore rupees. Additionally, in the fluorochemicals business, there was a fear that the anti-dumping duty on one of the refrigerant products could impact the entire industry. But SRF indicated that R125, which is the product, is not going to see much of an impact on SRF because they are focusing on other products, so the street should not be worried about that. Morgan Stanley has an overweight rating with a target price of 2,555. They say the management addressed concerns around demand and margins in all its verticals and pointed to a gradual improvement for demand and realizations in FY25. UBS has a buy with a target price of 2,700. They see a cyclical bottom for this name, and they also see that worst appears priced in, so they are bullish on this name.
All right, Sonal, thanks very much for that. So that's SRF in focus. Asian Paints is what we want to sort of shine the spotlight next on. Mangalam is here with details. Mangalam, morning.
Good morning. So yesterday the stock was down 5% post the numbers. The volumes grew 10%, but despite that, the numbers were a miss on all fronts. The management in the conference call guided for double-digit volume growth in the first quarter of this year and the entire year of FY25 as well, with margins between 18 to 20%. However, they've reiterated that, the gap between volume and value is likely to be around 5 to 6%, telling you that revenue growth for FY25 won't be more than mid-single digits as well. Stock is down 25% from the peak, yet brokerages see further red. And we haven't even spoken about Birla Opus entering the market yet, which is likely to be in full steam in the third quarter of this year itself. Jefferies says valuations at 50 times are expensive. They've trimmed their EPS and lowered the target multiple to 40 times. They have an underperformed rating with a target price of 2,200. Citi has a sell call target of 2,600. They're saying that, it's the price cut and downtrading that led to a revenue decline for the company for the first time in a long time. If you take out COVID as well. ICICI Securities too has a reduced rating with a target of 2,450, saying that the competitive equilibrium in the paints industry is likely to, it's broken, and EBITDA margins will decrease over the next 2 financial years. And Philip Cap too has trimmed not only their EPS estimates, but also they valued the company at a 15% discount to its 5-year trading multiple of 57 times, revised target price sub 3,000 at 2,950.
All right. Mangalam, thank you very much for that. So that's Asian Paints in focus. There's a minute to go to start. Mitesh is with us. Mitesh, sorry, that when we talked about the Nifty, what's your kind of level? Where do we get to? Just to kind of revise that.
Prashant, on a very logical basis, my understanding is that we should definitely test 21,640 in the sense that we have a higher probability of that. So 21,650, 600 is the first target area, and below that, I'm looking at 21,350. So I think both these targets look feasible to me when I look at the weekly and the monthly charts.
Okay. And what kind of probabilities would you put to that outcome? More than 50%?
More than 2/3 of them.
More than 2/3, okay. Well, 2/3 is the magic number, isn't it? In more ways than one right now. Well, we'll see. The market opening, I think, is coming up very, very shortly, just a few seconds from now. And we'll get the first rates, which will start to come up on our screens. And we'll talk about stocks. What do we have? The Nifty starting very tentative, very tentative. 21,982 is where the Nifty is at. 72,400 plus is where the sensex is at right now. So it's a 40-point start on the Nifty higher and about a 90-point start higher on the sensex. So first a couple of hours is going to be a little tentative with everyone kind of watching what's happening and before things settle down. Mid-cap index is up 1/3%. The small-cap index is up as well, about 1/4% Those two areas, of course, have seen, have had it worse as compared to the Nifty over the last 4-5 trading sessions now. Yesterday as well, both these indices were down about 2% each. But that's the indices. But stocks is where most of the action is always there. Sonia's got those rates. Sonia.
Well, thanks a lot for that, Prashant. I think the important number to look at is here, right? The BSE advanced decline ratio. Now, for now, it's looking good. It's not too bad. So there are almost 1,000 stocks on the advancing side, which indicates that perhaps today we are heading for a stable day, but it may be too soon to call. At least the initial tick indicates that it's not such a bad opening for the market. So as you can see, still below the 22,000 mark, but hanging on without any cut this morning. Let's get straight to individual stocks. I'm interested to see what's happening with SBI this morning because as we've been telling you, a lot of brokerages coming in and raising their target prices on SBI. So up almost 1%. Nomura has a target price of 1,000 rupees. Morgan Stanley has a target price of 800. SBI has crossed that. But in general, the mood is good on SBI. In the broader markets, Escorts is something I'm looking at. Now, the commentary of the management was quite muted. The revenues were also under pressure. But there is some recovery that Escorts is seeing this morning. Interesting here, up almost 2.5%. Some of the numbers that came in post-market hours. I'm looking at BPCL this morning, 4.5% higher. Q4 was largely in line with estimates. The EBITDA actually rose 50% and the margins were up 250 basis points quarter on quarter. So BPCL really shining through this morning. Apart from that, Max Financial is up about 1.5%. The April total APE went up 35% and the retail APE was up almost 32%. So looking pretty good on Max Financials. Now, SRF is the one that I think a lot of people on the street are watching, but the stock is not doing anything this morning. The FY25 chemical business growth is seen at 20% and the margins at 26 to 27%. Apart from that, Abbott, let's look at that, 2.5% higher. Revenues are up 7%. Margins have risen 100 basis points year on year. LIC is the other one. The April premium has gone up about 113%. And the total APE has risen 31%. Retail annual premium equivalent is up 18%. So good numbers coming in from LIC. That stock is well in the green. Now, Brigade Enterprises has been in the news for the last many days. They're developing several projects, a new residential project in Bengaluru. The sales value is 660 crores, so look at that. Today, two big numbers from the auto space coming in post-market hours. There's Tata Motors, expected to be a strong set because JLR was pretty good this quarter in terms of volume growth. And there's also Eicher Motors, not great numbers because there's been a bit of a slowdown in the commercial vehicle piece. Apart from that, I'm also looking out for Mahanagar Gas. Let's get that stock up for you. The volumes were below estimates. The margins fell quarter on quarter, so the street doesn't like those numbers too much. Asian Paints, as we've been telling you, the numbers were weak. The stock was down 5% post numbers, and a lot of brokerages coming out with views. Jefferies says the Q4 was an all-round miss, so the street doesn't like that. In any case, Asian Paints has been underperforming for a while. But let's get back to the headline index, which everyone is tracking now. Still quite steady state actually on the Nifty, up about 50 odd points, as you can see, holding on to the 22,000 mark. But the day is long, so let's see which way things go. Back to you.
All right, Sonia, thanks a lot for that. Well, tech is under some pressure today. Infosys is down close to around 1.5%. I'm just looking at global news. Overnight, you had EPAM that came out with its set of numbers, and they have given another guidance cut on sluggish recovery. So Infosys is down close to around 1.5%, maybe some part of some kind of a rub-off based on what EPAM had to say. But the stock that's getting clobbered this morning is Intellect Design. It's down 14%. I was just looking at it on a sequential basis. The revenues have degrown, margins have improved a little bit, but the street has not taken it too kindly. Remember, these are one of the stocks that have done very, very well in the recent past, and valuations as well were not very supportive. So on the back of weak numbers, not too much comfort on valuations, the stock is down close to around 14%. Sharp downtick out there. Persistent Systems as well down close to around 2.5%. What's doing well then? Well, a couple of good earnings reactions we've got. Suryoday Small Finance Bank, that's up close to around 2%. Manappuram Finance got slammed yesterday. The management came out with a clarification as well. So from the lows, it's seen a bit of a bounce. It's up close to around 2.5% odd. A few more notable movers in trade today. UCO Bank is down close to around 1%. That's one of the top volume movers in trade today. The stock of the morning has to be BPCL. That's up 3.5% odd. ITC is putting on some weight, up close to around 1.5%, while the tech pack is seeing a bit of a decline. Infosys is down. You have LTI Mindtree as well from the Nifty pack, both of them under some pressure. And SPI, stock is still holding in the green. The numbers look good. The stock has already run up considerably, 28% in this year so far, but it's still holding mildly in the green. And as we did that market check, Prashant, the markets almost moved into the red. The Nifty Bank, the swing factor of the day, can it stop this decline that we have seen in the last few sessions? 5% from the top. Prashant.
You know, Nigel, once after a day like yesterday, once you will get, in the morning you will get a swing and maybe a test of the low. But then after that, can we find some stability? That is the point we'll have to see. 21,950 is where the Nifty is at. So just as we speak, we're in the, it's blinking red and green. The normal kind of day would be nice as we go into the weekend. Now, we got, 1,200 stocks higher, 800 stocks lower. That is the advanced decline ratio. BPCL is the biggest volume-led gainer with a 3 1/3% pop. LIC is coming out of nowhere, 1.5% gain, 916 on LIC, and it's got huge volumes right now. There's something like a Jupiter Wagon, small name, but volumes are third largest across, 3% higher. We had the management with us recently. Manappuram ended about 7% lower. That's gaining 3% down. Actually, it was strange because Muthoot came on the air yesterday, said, well, these new RBI cash disbursement limits and the reiteration of that doesn't really impact them. Muthoot ended flat and Manappuram ended down 7. So Manappuram is up a little bit, so maybe making up for that. Escorts is up about 3%. Sonia mentioned that. Paytm is up about 2%. Moil is up 3%. Castrol starts about 4% higher, 195-ish. CAMS is up about 2.25%. We'll be speaking with the management of CAMS in a bit from now. So this is, some of what is going on across the board. I think we, of course, mentioned Intellect. Maybe look at Elecon Engineering as well. That's down 7%, and it's got volumes behind it. MGL is down about 2 1/3%. Sterling Wilson and Solar is down about 3%. And it's just opening up. Kirloskar Oil Engines, of course, had a big move up. So it's seeing a bit of a pullback down about 2.5% or so. So that is the picture. So absolutely flat, quiet. 7 points on the index, 11 points, 21,970 is where we're at. Devina Mehra, founder, chairperson and managing director at First Global, is our market master of the day. She's with us. Devina, good morning. Good to have you with us here. It's always a pleasure. Prashant this side. What's worrying the market at the margin, Devina? I was joking with Mitesh about that. He was talking about the 2/3 probability. But of course, that was in the context of the Nifty. But just wanted your thoughts to begin this conversation with, Devina.
Good morning, Prashant, and a good morning to the viewers as well. We were expecting some volatility in the short term. So if you see my last interview also, that's what I had said, that while we remain positive in the medium term, at that time I'd said in the 2.5 month kind of horizon, we thought there was going to be volatility. So we have been hedged. We were hedged in March. Those hedges expired. We put on the hedges again in April. So on our PMS portfolios, we have been hedged because our system signaled a possible volatility. So we are not really surprised that this sort of thing is happening, and we are positioned for that. But on the other hand, as I said, since we were not negative on a medium-term basis, we have not made any cash calls. We have not gone into cash.
Okay, you've not gone into cash and you haven't taken any cash calls. Interesting. But Devina, which way do you think the market would swing if the incumbent government doesn't come back into power with a major majority? Because that's what the fear is in this market now. Do you think it will have a big impact on the market post-elections?
Even if that happens, I think the impact will be temporary because if you go back for exactly 20 years, 2004, I think was the biggest upset in election history, where the incumbent government was so confident that they actually advanced the elections by 6 months because they were sure they were going to win. And they lost so badly that I think something like 80% of the cabinet ministers lost their seats. And that day, of course, the market crashed, if I'm not mistaken. The index itself reached the circuit and the trading was halted for some time. But the market forgot it in a couple of weeks' time, and that 1 year basis, that was one amongst the best years in market history. So I think we focus too much on election results. The markets have a mind of their own. India has a momentum of its own.
Hi, Devina. Good morning and good to see you. People tell me, Nigel, you've not seen 2004. At least the downside, I hope I don't see that kind of, lower circuit and that kind of thing. So, let's look ahead then. Devina, the last time you joined us, you said few sectors that are quite positive on. If I remember correctly, industrials, pharma and auto. Currently, are you still overweight on that space? So will you be looking to buy out there, or have you turned things around?
No, we just did our quarterly rebalance in April. So things have not changed from there. Industrials and capital goods, just to remind you, we've been overweight since October 2021, whereas most people started talking about it only last year, only in 2023. So over time, we have cut exposure, we have changed the stocks because many of them even doubled and tripled. So we're not as overweight as we used to be, but we are still overweight. But the question, of course, we ask now every quarter is that, is the story over? Till now, our systems have not signaled that the story is over. So we still remain overweight. And you're right, pharma, autos, some construction, those are the other things we have been overweight on. Where we added more recently have been some commodities, metals and cement. Though, we're not overweight there, but earlier we had very little there, so we've added some there. Most latest addition has been a bank where we still, banking as a whole, we still remain underweight, but after a bad phase, it's not looking quite so bad anymore. So some of the stocks are beginning to look a little better than they used to. So that would be broadly where we are.
No, got that. Devina, and this is something that my colleague Nimesh is going to talk about a little later on Editors Roundtable in the afternoon, in the evening actually. The fact that we're seeing a lot of coverage starting to come through on sectors which are India manufacturing, defense, for example, right, is one area. But a lot of coverage is now coming after stocks have moved up 8, 10, 15 times, 20 times in some cases, right? So there is that feeling of FOMO. Maybe it was not liquid enough. There are institutional constraints. But now, of course, investors are asking them, well, why don't you have coverage? Tell us more about this. We want to know. And maybe it'll be followed by buying. But just what's your sense? And this is true not just for defense, but capital goods, industrials, a lot of areas. The coverage universe for a lot of people is widening. How do you look at this?
I don't pay much attention to what brokerage coverage says, because many of those things have agendas. I was on that side of the table at one point.
Would you look at that as a bit of a? Would you look at that as a contra indicator, or is that going too far? Because as I said, they're all coming after stocks have run up 10, 20 times.
Yes, exactly. That's the point. See, as I told you, capital goods, industrial machinery, we went overweight in October 2021. For most human beings, whether fund managers or brokerages, there was that overhang that this is a terrible sector, because it was a dog sector from 2009 to 2021, so 12 long years. But because humans carry that story and bias forward, that for a long time, even when things changed for the sector, people still thought it's not a sector worth looking at. And whereas we went overweight, and as I said, most people have jumped in very late. And we evaluate every quarter whether that story is over. As of now, our systems have not signaled, but as I said, we have cut back, but we are still overweight. Just as, we are now watching IT, that sometime this year, I think that will bottom out and that will give a good buying opportunity. We are not overweight currently, but so you always have to do things which data shows. That's why we follow this human plus machine system, so that human biases don't come into the picture. We look at things on a bias-free basis. In 2021 beginning, for example, I think almost the first FMCG stock our systems liked was ITC, which was among our top 5 performers for the next 2 years. But many people discovered it when a lot of the move had already gone.
This human plus machine thing is something all of us need to get used to, right? At least in across most professions. But Devina, I wanted your thoughts on the auto space, not particularly auto, but this whole premiumization theme, right? Because any segment you pick, whether it's travel, you see Interglobe Aviation at a fresh high, whether it's hotels, you see Indian hotels at a fresh high. In the premium auto segment, you see M&M at a fresh high. in the premium FMCG segment, you see some of these, say, platform aggregators like Zomato at fresh highs. So this whole premiumization theme is something that's working quite a bit. You think there's more to go on the upside here? And if yes, what are the stocks that you'd like in this space?
You have to go stock by stock and business by business. But if you look at the economy as a whole, clearly that is very much how the economy has panned out. We all saw that in equity report, which showed that now 65% of the wealth of the country is in the top 10%. It used to be 40% not very long ago. I was reading this Rama Bijapurkar's book, Lilliput Land, and one of the things which struck me is that for the lowest 60% and particularly the lowest 20% of the population, incomes have actually come down. From 2016 onward, the trajectory has been down. If you look at the lowest 60% in terms of income, now they make no surplus. So just income minus routine expenditure, not even taking one-time expenditure into account, that number is negative. So they're generating no surplus at all. So that's what is playing out. You will see that in sector after sector, that the entry-level stuff is not doing well, and whereas the high-end is selling, there might even be a waiting list and things like premium SUVs or cars. But 80 crore Indians need free ration. So that tells you how the bulk of the population is doing.
Absolutely. Devina, good to speak with you. Thank you very much for your time. It's a pleasure. And, hope we can have a couple more of these interactions running into the election. And, of course, we'd love to have your reaction on that important day as well. Thank you for joining us.
Thank you.
Well, that's look at the market. I just want to make a quick mention of it. It's a nice, decent bounce now. A 90-point. Now, fingers crossed, we should hold this. So 22,050 is where we are at. At the high point, the market started, dipped a little bit. It was flat to slightly lower, and then it's a nice kind of a smooth ride up. So, we'll take that. If this is just a quiet and normal kind of a day, I think it would be lovely to have this Friday morning. But it's too early in the day. Just 15-20 minutes of trade is what we've had. 22,044 for now. But I think we've got our first management on earnings with us, Nigel.
Well, let's get straight to it then. Indian overseas banks, the numbers look quite good. Mr. Ajay Kumar Srivastava, the Chief MD as well as CEO of the company, joins us on the show. Hi, Mr. Srivastava. Good morning and good to see you in. Congratulations on a pretty good showing in the past quarter. Give us a few numbers, though.
Good morning.
Your
Thank you.
Yields seem to have improved massively, and that's what's led the NIMs as well to do quite well. The last time we chatted, you all were talking about 3.15% odd of NIMs, but you've done much better than that. So tell us, how did the yields rise so much, and what are the guidance on the NIMs as well going ahead?
Yeah, because for NIM, there are two primary reasons. First is that we have increased our interest income. We have lent mostly to those sectors where yield is more. That is one part. And second thing is that we have been able to maintain our CASA, that low-cost deposit percentage. And in fact, we have improved, if you see year on year, from 43.74% to 43.90%. So the interest income we have increased, and at the same time, the interest paid expenses that we have reduced by controlling or increasing our CASA. We did not go for high-cost bulk deposits, and a mixture of these two has resulted in improvement in NIM to 3.28. And to reply to your second question, going forward, we intend to maintain at this level around 3.25, 3.30. Going forward, there will be a challenge on margin because deposit is getting costlier day by day. But we have our plans absolutely concretized, and we are implementing it successfully. And we do hope that by the same strategy, we'll be able to maintain it.
Got it. Mr. Srivastava, so you'll maintain your margins around these level itself. I want to understand a little bit about your asset quality. That has improved sharply this time around. What's the guidance for asset quality by the end of FY25? And what were the write-offs that you saw in this quarter?
Yeah, write-off in this quarter was very minimum, around 400 crores against a total recovery of 1,416 crores in this quarter. So the recovery has been, improvement in recovery has been a mix of various strategies like auctions and ARC sales and upgradation. So all these things have yielded result. And the guidance for next year, we are intending to bring it down by at least 100 bips going forward. And we have, last week, we have gone for aggressive ARC sale also. 92 accounts we have put on block, amounting to 13,000 crores. And we are getting good response from various ARCs. And I do hope that this will also be, I will say, accomplished successfully. We are going to get a good value out of that.
Okay, all right. Mr. Srivastava, what about the gross NPAs and net NPAs? What is the number you want to guide for? It's improved to 3.1% and 0.57%.
Yeah, gross NPA, as I said, that our plan is to reduce it by 100 bips. So maybe around 2.10 we are intending to close by next financial year. Right. And accordingly, net NPA, we are looking at around 0.25 to 0.30 at the end of the financial year 25.
Okay, all right. So we've got some numbers on margins as well as on asset quality. What about guidance on loan growth as well as deposit growth? Could you give us that? I think you were talking about mid-teens the last time on loan growth.
Yeah, loan growth, if you see over last two financial years, we grew by almost 24% in 22-23. And this year, which has just gone by, we have grown by almost 16%. And going forward also, guidance will be same. We intend to grow at around 13-14% total credit. And we are pretty confident that looking at the demand in the market, we are getting a good amount of queries also. I think 13-14% it will be easily maintained.
Okay, 13-14% you will be able to maintain. Can you break that up for us? Where are you seeing maximum demand for loans come through from? Is it from the corporate segment? Is it personal loans? And also, you know, you can tell us a little bit about agri loans, rural market, any kind of qualitative data that you can share with us?
Yes, growth is all around. If you look at IOB's portfolio, we are having almost 70% of RAM that you call popularly as retail, agri and MSME. And around 31-32% is corporate credit. And we have grown in all these four parameters in double digit, around 12-13% to 16%, 17%. So uniform growth has been there. There is not any particular sector in which we want to focus more. For us, these four sectors carry equal importance. And depending on the quality of proposals or offers which we are getting, we will take a call depending on all other factors. And overall, we intend to grow in all these four sectors in double digit. And growth will be uniform. If you look at the portfolio, retail, agri, MSME, all is around 25-26% of the total portfolio. So we want to maintain that level. That spreads the risk and it gives us lots of comfort.
Okay. So you said that the retail, agri, MSME, right? The largest chunk that you operate in. In agri, I want to understand, are you not seeing any slowdown at all? Because certain pockets, like say tractors, for example, small part, but there is a big slowdown that's underway. A lot of the tractor manufacturers are talking about further slowdown in FY25. So in the agri segment, on an average, what has the growth been and any kind of slowdown there?
Yeah, in agri, of course, tractor sector, as you say, the demand has been muted. Of course, we are also observing this over the last 1 year. But there are many other sectors which comprises of the total agri. If you look at, it's not only direct agriculture or these add-ons like tractor, ancillary businesses. There have been many other things also which have been included in as part of agri, like ethanol project, like food processing sectors. So there are many other sectors where mid-corporate, mid-level around 50 crores, 100 crores or 200 crores. That type of proposals are also, we are getting good number of proposals we are getting. Ethanol, of course, everyone knows that it is on the priority list of the government. So we are focusing in those areas also so that we can maintain that growth of 15-16% in credit, agriculture credit.
Okay, you've given us most of the numbers, Mr. Srivastava. Final question before we let you go. Will you all be tapping the markets and FPOs on the cards in FY25 first half of the year?
Yes, exactly. We have already taken board approval. We are intending to go to the market. The approval has been to the tune of 5,000 crores. And we intend to go to the market in 3 or 4 tranches. Certain other approvals are under process. And maybe in by end of Q2 or Q3, we plan to hit the market.
Thanks a lot for joining in, Mr. Srivastava. Wishing you all the best for the remainder of FY25. Well, as we're having the chat with the management of IOP, the advance decline ratio should come up for you. That's skewed a little bit, and the mid-cap index has moved into the red. So just keep an eye out on that index. For the time being, we'll slip into a short break. You come back, we'll get chatting with the management of Escorts. That's the stock of the morning. The stock is holding up well in the green.
Welcome back. Well, for now, the market is not bad, actually, holding on to the green line. The sensex is up about 800 odd points. It's quiet, and quiet is good after the volatility we've seen in the last few days. So it gives us some time to talk about some numbers. Escorts Kubota was a weak quarter. The revenues actually declined. There was a slowdown in the tractor business. Their construction and railway business were not bad. It was stable for the quarter. But importantly, the management in the conference call gave a very muted guidance for the full year. Bharat Madan, the whole-time director and CFO of Escorts Kubota, joins us now to talk about that. Sir, thanks a lot for joining in. You know, the slowdown in the tractor business is clearly visible. FY24, your tractor volumes were down for the full year by about 7.5%. You said demand in Q1 is expected to be weak. But can you quantify for us, in the first half of the year, how much could your volumes fall?
Hi, good morning, Sonia. So I think we are seeing this weak trend now after the last monsoon. So third quarter also had started showing the signs of decline, and fourth quarter we saw the decline was slightly steeper at almost 18-19%, where the industry went down. So this quarter also we're seeing the softness, even though April was a month which was more or less flattish. 1-2% degrowth was there because the festive season shifted this time to April. So that actually reduced the impact of the drop. But otherwise, the sentiments were not very strong on the market side. And then coupled with the election scenario, I think some demand has been injected. So this quarter we expect, I think it will be a soft quarter for us. So we still expect it to be a single-digit degrowth, which will happen in the industry numbers. So May, June may still see a slow growth. I think going forward, once the monsoon starts, if the pickup is good and distribution starts, maybe the sentiment will start improving. So July, August may be more like flattish month. September onwards, we'll see the pickup start happening, if we really see a good monsoon this time.
Okay, so you're saying a single-digit degrowth is what you're expecting in Q1, and the sentiment is still not strong in the tractor market. Got that. So, do you think that with this degrowth, there could be a sort of a compression in margins as well? So far, you've been holding margins at around 10.5 to 11%. I think in this quarter, you saw 11.2% margins. And you did mention there are some cost efficiencies that you're undertaking. But do you reckon that with this kind of a slowdown on the top line, maybe your margins could come to single digits at some point as well in FY25?
No, Sonia, margin-wise, we are not really much worried. We don't expect the margin will come down to single digit now because the margin active have held back, and actually now we'll start getting the benefit of the full price realizations also, and commodity price continue to be soft. So we'd given a guidance the margin for tractor will continue to be in 13 to 14% range. We won't see it dipping down to single digit in this quarter or this year.
Mr. Madan, hi, good morning. Prashant here. So just to tie that number in, so last year, FY24, I think you were down 5%, which is better than the industry. You're saying single-digit degrowth this in FY25 as well, for the full year as well?
No. So I said only for the first quarter.
First quarter.
Yeah, because after that was post-monsoon, we expect the recovery should start happening. So from September
so low, mid, single-digit growth.
Overall, it will be low single-digit growth for next year, full year.
Okay. And, so the elections, etc., you mentioned a few factors. How do you assess consumer sentiment as such? If you sort of keep away elections and monsoons are expected to be normal, I mean, how do you sort of assess consumer sentiment in the market right now, Mr. Madan?
I think we've seen some now sentiments have been improving, especially in pockets like Maharashtra. We've seen this time the volumes were good. The Gudi Padwa was the festive season, so we saw good numbers coming in from Maharashtra. And we also improved our market share in Maharashtra. So I think that's a positive sign because the rainfall typically had impacted the southern and western market the most, which is what impacted the industry. So the stronger market in north and central was not really impacted to that extent. So we've seen good traction coming in from markets like Rajasthan, even UP, to some extent, and now Madhya Pradesh. So overall, I think the positivity is there, I think in certain pockets, but wherever the impacts were more because of the patchy monsoon last time, so there we'll see the recovery will start happening now.
All right. Good morning, Mr. Madan, and thanks a lot for joining in. This is Nigel on this side. I had a two-part question. You all had put out a midterm guidance, I think in 2022, towards the end out there. And one of the targets was to double your market share. But as I see, there's not too much movement on the market share. So could you tell us what it is and where is it headed? Point number one. And point number two, on the implements business, you all had guided that you're likely to see that triple. What was the updated number for FY24 on the implements business, which is a smaller part?
Sure. I think to the first question, I think once we had given the midterm business plan, which is based on the consolidated entity. So as you know, there are two joint ventures with Kubota, which will get merged into Escorts now very soon. We're expecting the order to come from NCLT anytime within this quarter. So those two JVs have roughly, they do about 20,000 tractors out sale, and they're also very good in the implement side. And they're doing very good business on the harvester and transplanter, where the volume is almost 300 crores plus. So I think post-merger, we will have a market share of close to 12-13% combined entity, which is what we are looking at doubling. Obviously, one of the reasons is the slight delay in the product introduction and the new product development process. But then the stabilization and integration is taking some time. And when that starts, we'll have all the white spaces filled in, for the new products, which will start coming in, in the market from this year itself, this year end. And then FY26, we'll see the full benefit coming in, from those product portfolios. So we'll see probably the moment and the market share will also start happening positively. So fortunately, in the last quarter, I think we've been able to gain 1% market share overall, especially in the stronger market. So which is a positive sign. And we expect with this, I think, new products coming in, that will also really help us post-integration, the merger. Same thing on the implement space, like you mentioned, since the implement is a big business for the JVs and post-consolidation, we expect that will be a good revenue driver for us going forward.
Okay, all right. Mr. Madan, just one more question from my end. In the past, there were some reports that suggested that you could be looking at selling the railway business. Is that on the cards?
No, it's all speculative. Actually, we denied that also to the stock exchanges. So there's no such news. Yes, we know Kubota is not really into the railway business globally. So it's not really a sector where they can add value. But that doesn't mean that it will be sold off. Obviously, we're looking at the right partner who can really help us in doing that business further.
Okay, so you're looking for a right partner to take that business further. Are you looking to tie up with anyone anytime soon in this calendar year? Should we look at any kind of strategic investor coming into the railway business?
So we already have multiple collaborations in that business for different product portfolios. So we're trying to expand that portfolio further now. Given the trending position from the government side, railway business is looking strong and it's showing very good growth, and we expect the similar growth momentum will continue this year too. So obviously it's the most profitable business for us right now.
Okay, so railways is the most profitable business. Got it. The construction business has also grown very well. I just want a number there because in FY24, your volumes went up almost 42% in construction. Is this the kind of pace of growth that you're expecting in FY25 as well? And what is the order visibility that you have in this business?
No, we don't expect the growth will be to the extent of 40-odd% this year. But the industry has already touched a new peak last year. So even if the industry maintains at that level, I think it will be a very good number. We need to continue with. Though we expect some growth will come in, but again, construction industry picks up after the monsoon season. So there again, we see the good growth will pick up at least post-September. Overall, the margin profile in the industry has really turned around. If you look at it, almost a double-digit margin in the last quarter for us. So which is almost touching now, catching up with the tractor business, in terms of margin profile. But it's a focus area for us, and we'll continue to add more products, and expand our portfolio in this segment.
Okay. All right, Mr. Madan, we'll leave it there. Good luck. Thank you very much for your time. PNB is the next company which is on our focus, one of the largest public sector banks, one of the largest banks as such. Well, numbers came in slightly maybe below street expectations. Loan growth came in, I think, about 11%. Margins were flat. Asset quality is improved, though. Mr. Atul Kumar Goel is Managing Director and CEO at the bank. He is joining us now to take some questions. Mr. Goel, good morning, sir. Thank you very much for your time. Prashant this side. Could you talk to us a little bit about what should we expect in terms of loan growth in FY25? Would it be up north of 11%, what you did in the quarter gone by? Just give us a sense, sir. How are things looking?
Yeah, very good morning, Prashant, and welcome to all the viewers of the CNBC-TV18. As far as credit growth is concerned, the guidance for the current financial year is around 11 to 12% also, as against the 11.20% we have achieved in the last year.
Okay, so between 11 and 12% for the full year FY25. What about net interest margins, Mr. Goel?
Net interest margin, we are giving the guidance, it will be more than the 10% for whatever we have achieved in the 23-24, and the same, if you see the last year also, the growth was last quarter on the same line.
No, I meant margins, sir.
Margin as 3.23 was the margin for the domestic, as well as the 3.10 for the global. And last year also we have given the guidance for the 2.923. The same guidance we are continuing for the current financial year.
All right. Good morning, sir, and good to see you. Give us an estimate about recoveries for FY25. Will it come in from NCLT cases or IBC cases?
It will be the mix of the all, because if you see my kitty for the NPA 90,000 rupees, 90,000 crore is the TWO and 46,000 crore rupees gross NPA. So it will be the mix for all the small as well as the corporate from the NCLT. Last year we have recovered around 3,300 crore from the NCLT. The same number we are expecting in the current year also. Overall guidance for the whole of the year, around 18,000 crore rupees we will recover from the NPA in the 24-25.
Okay, 18,000 crore rupees you'll recover. So what is the gross NPA target by the end of FY25? I didn't get that.
Gross NPA 5.73 we have achieved on the March 24th. So it will be below 5% as far as net is concerned. 0.73 it was in the March 24. It will be below 0.50 by the end of the March 25.
Okay, so gross NPAs you're saying will be below 5% by the end of FY25, currently at 5.73%. So there's further recovery expected. Any fundraising plans that the bank has in FY25?
As far as fundraising is concerned, we have already got the approval from the board for 7,500 QIP, 7,000 crore rupees for the 81 and 3,000 crore rupees for the Tier 2. The total plan for the 17,500 crore for the current financial year.
Okay, Mr. Goel, the other big talking point lately has been, of course, this entire bit about project financing and how one has to raise, standard asset provisioning for that. We heard from the SBI chairman after the results, and we've been sort of speaking with others as well. Could you tell us what is the exposure there for PNB, and should we expect any impact whatsoever on any metric if this does indeed go up to 5% in a phased manner?
Prashant, although it is a draft guidelines and the view has been taken from all the stakeholders from the regulator on the till 15th of the June 2024, as far as our bank is concerned, so our total exposure in the infra is the around 92,000 crore, and 50% of that will come under this category. As far as PNB is concerned, there should not be any worry if the final guidelines is coming for making any provision also. That is not an issue at all in the Punjab National Bank, because now our balance sheet is very strong.
So 45,000 crores is exposure to project finance, which gets impacted because of this if it does go up to 5%. But you're saying that there is no impact.
Although RBI is giving the 3 years time for that also, because 5% we are not required to make immediately.
Sure. And that 3 may become even longer. Depending on, we'll have to see the final thing. This is, of course, only draft guidelines, and we'll see what really comes of it. But you're saying there's no impact because of this, right? Even if it goes to 5.
Yeah, whatever the impact will be there on account of the higher provision, as I told you, we will be in a position to provide, and we will pass on the whatever the impact to the credit debtors also. Yeah.
Okay, all right. Final question, sir. Before we let you go, your annualized credit cost, that's come in at the lowest levels in the last 9 years. Could you give us a guidance on that number, point number 1? But your OPEX, that's moved higher. I think the cost to income is the highest in 10 quarters. So give us a guidance on both these two numbers, cost to income, as well as if you could give on credit cost.
D'Souza, first I will give the answer of the credit cost. Credit cost, if you see, the last quarter it was 0.80, and for whole of the year it has 1.40. So we are giving the guidelines for the credit cost. It will further go down. It will be less than 1% for the 24-25 because provision coverage ratio is already more than 95%.
Okay. Sir, you gave us your guidance on asset quality, but I didn't get the slippages number. Would you have any sense of which way the slippages are going to go in FY25? What could be the average, slippages per quarter?
Slippage for if you see the last quarter, it was 0.98, and whole of the year it was 0.70%, and we are hopeful it will be less than the 1% in the current financial year.
Okay, it will be less than 1% in FY25, you said, right?
Yeah.
Okay, got it. I had just one more question. We were just speaking with another banker a while back who suggested to us that there is recovery in certain pockets in the rural market as well. But, overall MSME, rural, there are still some pain points. In terms of loan growth, where are the pockets of pain that you're still feeling, which could perhaps lead to muted loan growth going forward?
Loan growth, if you see the focus area for the bank is the RAM, retail, agri, as well as the MSME also. If you see the growth in the total advances was 11.20%, but growth in the retail was around 15%, and even for the housing it was 14%. The vehicle, there was a growth of around 25%. The growth is also coming from the rural and the tier 2, tier 1 city also.
All right. Mr. Goel, we'll leave it there. Thank you very much for your time. Appreciate it very much here on CNBC-TV18. I think we'll take a quick commercial break here. But okay, we'll bring in Mitesh. Look at the bounce, right? The bounce is there. It's real. 130, 140 points, 22,090. It's kind of bounced off those levels, 21,930-ish. Not quite there. We didn't quite get there, but... it's a real bounce, and not even 1 hour into trading. So I think maybe a couple of hours, and maybe you can say that, this is holding. Mitesh is with us, though, in terms of what you should do. I mean, as you look at this market. Mitesh, what's your sense? Mitesh, I think you'll have to unmute yourself. Yeah.
My idea remains that the market is bearish and weak, and therefore, we will look at shorting at slightly higher levels. The levels which I prefer, and I think this pullback can possibly play it up to 22,150 to about 22,220. That's the zone which I think the market will face strong supply. So slightly higher, I think around 22,150, we'll want to get into some short position. Now that can be done via directly shorting futures. If you're doing that, then take about 80 odd point kind of a stop. And if you are or you can buy into put spreads, which will give you profitable positions when the markets are slightly negative. So till we see a closing about 22,220, 22,230, I'll still maintain a negative bias. Though on stock side, I have maintained FMCG as the buying area, so I have a buy call over there. Godrej Consumer is something which is sideways for the last 2 days, so buy here with a stop at 1,300 for targets of 1,400, and Dabur is the other one which I would recommend buying with a stop just below days low of 540 and look at targets of 570.
Okay, the Godrej Consumer and Dabur, you said, right? A couple of other names that I wanted to check with you. What's your view now on SBI? Do you see further market upside, a fresh buying interest? And some of these life insurance companies are seeing a bit of a pickup at the moment. HDFC Life is seeing some traction as well. Anything that you see here on the charts?
See, SBI, in the entire financial and banking names, SBI has remained an outperformer, and I think it still looks good to me. As long as the stock is above levels of 780, I think decline should be used to buy it over here. But for the life insurance companies, particularly stocks like HDFC Life, ICICI Pru, etc., I think looks like a bounce back from oversold levels. Again, more of a pullback, which should get sold into at slightly higher levels.
Okay, all right. Mitesh, thanks very much for that. Well, we'll take a quick commercial break here. We are back and we'll have the management of CAMS to discuss their fourth quarter numbers. We'll look into F525 as well. Lots of sort of non-mutual fund businesses which CAMS is getting into, and what can that mean for the business? So Anuj Kumar, Managing Director of the company, on the other side.
Welcome back. Well, let's focus on the next management, CAMS. For their quarter four, their margins have improved. Strong equity inflows have aided the mutual fund business, while the cost-to-income ratio has also improved. We're now joined by Mr. Anuj Kumar, the MD of CAMS, who joins us to discuss the past quarter's numbers and the way ahead. Hi, Mr. Kumar. Good morning and congratulations on a good showing. Well, according to your earlier guidance, the non-mutual fund business, you expected it to grow by around 20%. But with these recent new developments, do you expect it to grow at a faster clip? And if you could tell us, what does it mean in terms of margins going ahead?
Hi, good morning. Thanks for having me on the show. Overall, if you see, we had sustained results in the fourth quarter. Non-mutual funds especially, revenue grew 52%. If I keep out the acquisition of Think360 on a constant base, they grew 38%. Look at it this way, that we've made major investments in building out the platforms for non-mutual fund businesses, especially for account aggregator, TSP, or utility, Bima Central, MF Central, etc. Now we are in the go-to-market stage where we are signing up new customers and we are scaling volumes and scaling revenue. So overall, this will be margin accretive as the build-out cost of platforms has kind of slowed down. That build-out has happened in FY22, 23, and 24. And now we will enjoy the benefits of scaling revenue in the same utilities.
Mr. Kumar, hi, good morning. Prashant here. So what will revenues in F25 grow by?
So if you see last year, we grew about 17%, a gross of about 165 crore of revenue addition. If there are no stressful phases in the market, which means markets hold out, I think a repeat of this should be entirely possible, which means expect us to deliver about high teens in revenue and maybe an identical profile in EBITDA growth. So about between 17-18% of revenue growth should be possible this year.
Got that. So high teens, so around what you did, 70% is possible in FY25 as well.
Yes, absolutely.
On the insurance side, where is that? So the IRDAI's mandate of policies in electronic form, has that started? Where is it at? And what do you make on dematerializing these policies?
So what's happening is that there is no explicit guidance for demat of insurance policies. There is explicit guidance on issuance of digital policies, which could also be placing them in the DigiLocker or just sending a PDF with an email. It is not a mandatory step towards demat. That's a different paradigm, which is not happening right now. What is definitely happening is that the new age consumer is beginning to realize the impact of, the benefits of e-insurance accounts. Some of this has kind of kindled interest, the recent announcements, but there is no one-way street to demat in insurance yet. When that happens, I think the scale will be very large. Today, this will lead to just incremental volumes, but not a major transformation in the markets.
Okay, so I just want to get this correct. Between the MF and the non-MF business, what is the kind of growth that you see, not just in FY25, but over the next couple of years? Where will the larger chunk of growth come in from, and what could the numbers be?
We're expecting MF to continue growing about 15%, non-MF to grow in excess of 20%. Like you saw last year, non-MF grew 52%, but that was an exceptional year. When you blend this, you should see us at least in FY25 to grow about 17-18% revenue, maybe an identical profile in profits. That is something that I can see happening because the base effect is anyways playing out, which means the significant increase quarter on quarter in FY24 will continue playing out as a benefit to us. So that is something we definitely believe will happen in the coming year.
Okay, so high teens growth is what you're looking at. I want to also ask you about the investments that you plan to make in your non-MF business. How much will the quarterly run rate be? Because you do have cash on your books as well to the tune of around 620 crores. How do you plan to utilize that? Any kind of inorganic growth opportunities that you're looking at?
So in terms of inorganic growth, we had made 2 investments in the last 2 years. The first was a small outfit called Fentuple Technologies. Last year, April, we signed up with Think360 to buy majority and control in them. So we continue to look for opportunities. These will be in the B2B space. We are keenly watching both insurance and payments and anything that we can do in the alternative space. So we could make an announcement during the year. There's nothing definitive yet. But yes, from a cash position, we are in a strong place. We do dividend out about 65% of our profits, but we're carrying over 600 crores in the group, in the main company and across subsidiaries, which can be used to fund acquisitions as and when we are able to identify a target.
All right, Mr. Kumar, final question then before we let you go. The non-MF business is likely to grow at a faster clip. Could you tell us what does it mean on margins, point number 1, and the cost to income ratio? What's the guidance?
So overall on margins, we have stated that we will be able to grow EBITDA margins by about 1% a year. I think the last quarter was an exceptional quarter where we grew EBITDA to about 46%. I think in the next ensuing 2 quarters, you should expect it to be between 45 to 46. And therefore, from a cost perspective, about 54-55% of revenue gets costed out. Expect that to happen over the next 2 quarters.
All right, Mr. Kumar, appreciate you joining in. Wishing you all the best out there. For the time being, the stock is holding in the green. As you said, high teens growth and margins at around 46% could be a one-off. Expected to trend a little bit lower in the time to come. Stock up 3%. Well, let's turn our attention away from the equity markets to the commodity markets. Manisha Gupta joins us to tell us what's going on there. Manisha.
Thank you for that, Nigel. Well, my eyes are on gold today because 1, it is Akshaya Tritiya, and 2, we've seen a very smart rebound over the night in case of the commodity there. So the prices are trading nearly a percentage point higher on the overnight markets and nearly 0.5% up at this point in time as well. Well, there are renewed rate cut bets, and that is what is supporting the gold prices. We are more than 2% up for this week itself. The Bank of England has signaled a cut coming in as early as this summer, and the US jobless claims, the data that came in yesterday, also suggests that you could be looking at at a rate cut coming forward in September. The jobless claims was the highest in 8 months. The markets will watch out for the US CPI and PPI data. Well, that comes in the next week, and that would give you further direction also. But the strong OTC demand, the Asian demand that the markets are looking at has been quite supportive there. Also, the markets are betting on a 69% chance that the September will bring in first rate cut from the US Fed. That has been supportive. If you look at the central bank buying, that has been on the stronger side as well. And I should show you those numbers because 2022 was a record buying from central banks at 1,082 tons of gold. Last year was a second record high at 1,037. In the first quarter of 2024, the central banks have bought 290 tons gold already. And the markets do believe that 1,000 is a level that you could see crossing by the central banks in this year as well. If you look at the Indian buying as well, the estimates are that 700 to 800 tons of gold consumption that India sees on an average would be seen in this year as well. This is what we've done in sense of prices on every Akshaya Tritiya. So if you bought gold in 2020, the gold prices were at 46.599. But the important price trends really come in the last 3 years itself. If you bought gold in last couple of years, you are looking at double-digit percentage growth in sense of gold prices. So 2022, gold prices were at around 50,000. Last year, same time, Akshaya Tritiya, it was at 60,000. Today, the 22-carat prices in the physical markets is trading at 73,000. So when you look at the last 3 years in sense of price moves, we have seen very strong gains come in for the gold prices there, with the expectation that you're looking at higher prices from here on as well. In the international markets, we are trading at $23.50 an ounce, with expectations that $2,500, $2,700 is where you could be headed. That would mean further higher highs for the Indian markets going forward.
Okay, all right. Manisha, thanks a lot for that. And I always take your advice for the last few years. I'll be buying some gold even today, Manisha. Thanks a lot for giving us that update and for the advice as well. Well, for the time, we'll slip into a short break. On the other side, we'll get chatting with the management of Larsen & Toubro. You don't want to miss this. Stay with us. Welcome back. Well, the big cue today has to be the Nifty Bank. That's been under pressure for the last 7 sessions. It's been seeing a lot of selling. It's down close to around 5% from the peak. Now, that's coming into form. That's up close to around 0.6%. And that's going to be the swing factor today. If the Nifty Bank can continue to build on to these gains, then it'll be pretty good news. For the time being, it's holding above the 50 DMA. The 20 DMA is around 400 points away from current levels. So that's one stock that we're looking at. The other one I'm looking at is Thyrocare. Just take a look at the massive volumes we've seen. Even yesterday, late in the session, we did see some volume spike up. But in the first hour of trade itself, we've seen more than 6 lakh shares getting traded out there and fairly volatile moves, as that chart is telling you. So keep an eye out on that stock, up close to around 4%. A few other notable names from the broader markets. IOB, we had a chat with the management. They sounded confident with regard to growth, asset quality, as well as NIMs. For the time being, IOB is up. It was trading in the red. It's moved to the high point of the day. And NHPC is another stock that was trading in the red. That as well, Prashant, has done a bit of a U-turn. So good start, a good first hour of trade. The bulls will like to maintain this sort of a pace and hold on to these gains. Let's see if that's possible.
Absolutely, Nigel. And, this is a nice bounce. I mean, I don't know if we can have that sort of nifty chart. Okay, I think we'll have that up a little later. But the big talking point, of course, also has been the L&T results. The stock was down sharply yesterday. And the disappointment largely is on the margin bit. Otherwise, I mean, it's been a pretty healthy sort of set of numbers which we've seen across the board from the infra major. The company is guided for a 10% growth in order inflow in FY25 on what was already a very elevated base. Mr. R. Shankar Raman is President, Whole-Time Director and CFO at Larsen & Toubro. Mr. Raman, thank you very much for your time. Great to have you with us here. Thank you for joining us. Prashant, this side. Margins is what I guess everyone is very focused on, and we'll come to that. But I just want to start by talking about the pipeline, right? Essentially, my question is to you about what we are hearing from Saudi Arabia in terms of, their spends on infrastructure being lowered, be it Aramco, be it that new city which was to come up. And these are sort of public statements we've heard. You've, sir, in commentary, essentially said that your pipeline is very, very strong for orders. FY25 pipeline is about $146 billion. That's up 24% year on year. In 24, this number was 14% higher. Have you factored in any sort of disturbance which comes from Saudi, or is it inclusive of this? Can this number reduce pretty dramatically as we go through the rest of the year? What are you seeing?
Good morning, Prashant. Good morning, viewers. Thank you for having me on the show. I think the way we look at pipeline is looking at all the prospects that the clients are working on. The time factor that it takes for some of these to actually convert into specific programs, thereafter to RFPs and thereafter to awards, is a pretty long one in particularly project business. So the first sign that we look at is how consistent and strong is the pipeline. And when we look at it from that perspective, 12 lakh crore or close to $150 billion worth of opportunities are looking available for investments to be made both in India and Middle East. Stepping back a bit on this pipeline, I think since we have 60% of our business coming in from India and 40%, we have to constantly keep looking at both the opportunities because the sizes of these opportunities are different and the resources that needs to be engaged in these opportunities are also vastly different. So considering that, we need to balance between our resources as well as our plans and growth aspirations. We constantly look at both and try to see where we can scale up. The advantage with Middle East so far has been that they've been investing in oil and gas, the geopolitical tensions, the frozen wars in Europe, etc., has led to a situation where pumping out more oil and gas energy continues to be profitable for the Middle Eastern companies. Oil at around $80 and thereabouts seems to be a fairly sweet spot for them to be able to cater to the global demand as well as generate resources for them to build their economies in a more broad-based fashion. There is a very stark realization over the last 5-7 years in these markets about the need to develop their business from a one-pony trick to a much larger economic engagement. The people are getting educated. People in Middle East needs to find profitable vocation. And consequently, the development of Middle East started towards, instead of a one city region of Dubai hogging all the limelight, we are now having alternate cities coming up. One is existing infrastructure getting strengthened. Middle East always was known for excellent roadways, but they did not really spend much time and energy or money in developing rail network. The cities were far flung, so possibly they didn't have the compulsion. Now, as you can see, if you travel there, Dubai and Abu Dhabi is almost connected by various development along the way. So it looks like one continuous stretch now as compared to what it was a few years ago. Now, given this development and the migration of people wanting to live there, because the social conditions in those regions are also improving. So if you look at Middle East from a holistic point of view, oil and gas will continue to be the fund provider for many of their efforts. the transition that they have done for solar is remarkable. We ourselves as a company are working on 18 gigawatts of solar power, and we're the single largest contractor out of India working in Middle East on this area. Given that trust that they have, because they have enough and more land, they have enough and more sun. So it's actually a no-brainer that solar capacity will come there thick and fast.
Mr. Shankaraman, since we, I don't know, fantastic points and a really comprehensive explanation about what's happening there, and that trend will continue. But, could you tell us what is your exposure from the Middle East? What's the exposure in terms of order booking from Saudi? If you can give us those two numbers. And as of now, you're not hearing anything, not just for you, but for others in the market, because you'd hear what's happening. No cancellations, no ram downs, nothing.
Yeah, we have totally the order book is about 4,75,000 crores, and we have almost 1,80,000 crores in the international markets. 80% of this order book is from Middle East, and within that 80%, almost 70%, 72% is Saudi. So Saudi dominates the order book. We have close to 1 lakh crore out of just that market in Saudi, and over Middle East it'll be maybe 1,25,000 crores. So that's the size of the pie that we have. These are orders that we have got in the bag, and this excludes the bids that we are evaluating for submission going forward. There would be a pause in terms of reallocation, because I think the sectors to which they want to reallocate capital, we've seen announcements, particularly from Saudi Aramco. But on a $60 billion per annum base of investments that they're talking about, a 10 billion shift is what they're talking about, 40 billion in 4 years. A 10 billion shift, according to me, is not going to upset our plans for Middle East, given our size and scope of engagement.
All right. Hi, good morning, Mr. Shankaraman, and good to see you in. This is Nigel on this side. What about the core margins? The street seemed a little bit disappointed with the guidance you've given out there. Do you think that you're being a little bit conservative on the guidance you've given? And is there an upside risk? And tell us why you're being so conservative.
We need to understand this margin business a bit. I know the street is not very happy by seeing a number at 8.2% that we have reported for the core. The portfolio as a whole has reported 10.6%, but you leave aside the services business and you just talk about projects and manufacturing business, we have printed 8.2%. And this was 8.6% last year. Last year, when we printed 8.6%, we were committing our resources towards earning this margin, almost 18-19% of our revenues. The 8.2% that we have reported for FY24 has 12% of revenue committed as resources. Now, in terms of this value creation, margin is one piece. The other lever is capital employed. How much capital do you employ to earn the money is a most important aspect in this. And what the street possibly has missed out is that the capital efficiency that we have packed in rather very well in FY24, we seem to have sort of lost sight of it. Secondly, the changing mix definitely has a role in all of this. Earlier, it used to be 20%, 22% of our order book used to be international. Today, it's 40%. What this means is the size of the projects goes up, so scale is high. Secondly, the absolute margin in Middle Eastern contracts are lower than Indian contracts. But the cash terms that are available, the payment terms, the milestone payments, the front-ending of cash flows are much stronger in Middle East. Now, given that the changing mix of international domestic order, it is to be expected that the 9%, 9.5% we used to print as margins when we are only focusing on India, essentially, will change. The point that is to be appreciated is that changing without any change in capital employed, or is it changing in tandem with capital employed? If I context it that way and look at the performance of the company, I think the value we have generated is reflected by 200 basis points improvement in ROCE and almost 270 basis points improvement in ROE. Now, we do believe we have created value for shareholders through the FY24 performance, and we'll continue to do that going forward. The margin and the capital employed are two levers which are dynamic, which will keep moving depending on the type of contract, the geography, etc. So my advice would be not to unduly lose sleep over the margin, but look at the overall value creation efficiency that we are demonstrating. But having said that, the company is committed and will do everything possible within our means to make sure that the margin improves to better levels, even during FY25. But given the fact we are almost looking at a 7-month or an 8-month year ahead, we thought that it may not be prudent for us to upscale this now, and maybe we'll reserve some good news for FY25, 26.
Okay, no, but take your point. So it's a balance, as you put it. So just focusing on that one number may perhaps not be the right way to do it, and perhaps the market will take note of that as well. Because of the elections this time around, briefly, Mr. Shankaraman, I had a few more questions. Is there any impact you're already starting to see, or not really?
In terms of the bids that we have submitted, the opening has got delayed. Obviously, I think once a code of conduct is announced, there is an inevitable slowdown, and that was actually anticipated, and this is the reason why we almost did 75% or 80% of what we need to do for the year by December. And we could then enter the last quarter with not so much of stress of having to meet the target. We well exceeded the target. Now, during the months that we are seeing now, and maybe right up to the election results, I don't expect these bids to be opened. So it's going to be more of focusing on executing. And as elections are happening, I think all our contract workforce are also getting scattered because they are all going back to their villages to cast their vote and whatever. So to that extent, there's going to be a bit of a reassembling of workforce. So from July or June end, our execution will start gathering pace to come to normal. In terms of fresh orders, I think the first phase would be to open up the bids that have been submitted. If there is continuity in the government and its policies, these bids will be opened and then awarded. If there's going to be a discontinuity, which I don't know how things will pan out, then there's going to be a question of what happens to these bids. Are they going to be cancelled, resubmitted, etc.? So there is an inevitable interruption that this event of national importance will throw up. And hence, we are thinking that for fresh orders to come in, it could be more from August, September. So it looks like a second half heavy year going forward, and which is largely the reason why we also scaled down the growth to about 10%. Not to say prospects are dimmer, it's just that ability, the time that is taking to convert all of this into specific orders could take all the time up to March 25.
Okay, maybe I can got that, sir. So it's like an H2 heavy kind of year. Two more questions. How are ridership trends in the Hyderabad metro? Is it on track for divestment? There is one. And can we expect a buyback next year given the strong cash generation overall from the company?
As far as Hyderabad metro is concerned, I think FY23 we closed there with average ridership of about 3.2 lakh per day. And the ridership has improved to 4.6 lakh per day as we closed FY24. In the month of April, we have seen about 4.7, 4.75 lakh per day ridership. I think it is very important that in the space of public-private partnership, the public policies have to actually take into account the private capital commitments. We had a new government in the state of Telangana, and one of the whole promises, which seems to have been implemented right away, was free bus passes to women of all age. Now, that shifted close to 30,000-40,000 people who are traveling in metro into the buses, because I think a free bus ride, free lunch, everybody prefers. But what it is also doing is pushing some of the men folk who are finding the buses very crowded back to metro. So we think that there'll be a shift, and some amount of gender diversity will not happen in the ridership. It'll be a little more male oriented. So we guess we'll get this traffic with some lead lag. We should be able to get this 5 lakh people back on the metro. Secondly, I think Hyderabad does have a lot of IT professionals working and using the metro. The return to work is still not complete. People are still working from their homes, etc. To that extent, the ridership is punching below its potential. It has potential to have another 50,000, 70,000 people traveling if the IT crowd really comes back to office. And the third part of it is we have about 18.5 million square feet of real estate attached to the metro. we've got approval for monetizing a few bits of that which we did in FY24. Approval is pending for a few more bits in FY25. And the state also has granted a soft loan, long-term interest-free soft loan of 3,000 crores, of which we have drawn 900 crores. We need to draw the balance 2,100 crore. So a bit of improved ridership, bit of monetization, and a bit of time crunching in terms of getting the soft loan will help us repay the debt. And the minute the debt equity improves for the project, even at about 5 lakh riders, then the asset becomes a little interesting to evaluate from an investor point of view. It is an asset we will monetize, but we'll have to make sure that we don't monetize at some discount and that it is monetized to its potential. Very few concessions are for 65 years in the country, and this is one such. So there's lots of cash to be had for investors at the back end, but we are going through the formative phase, which is the harder grind that we are passing through now. As far as buyback, etc., I think our idea was to make sure we create value for shareholders. Dividend and buyback are part of the entire shareholders return program. As and when, and we have made a start because first time ever the company did a buyback last year and it's been well received. So we've sort of tasted that's a workable option. We'll continue to evaluate that, and we are very clear that we are handling shareholders' money as its custodian. If we can't put that to best use, it is best to give back the shareholders their money, and they can choose what they want to do, including investing in our stocks.
Okay, all right. Well put, Mr. Shankarman. Great clarity there. Thank you very much for your time. It's a pleasure having you with us here on CNBC-TV18. Good luck, sir, as you sort of conduct your business through F525. We'll speak with you again. The stock's absolutely flat, down about 1/3% after yesterday's 6% sell-off. The Nifty, by the way, will come up on your screen. I think we're still up over 100 points. And the rates are on your screen, 131. So holding for now. And I think we are now passing that, 1 hour mark. 22,083 on the Nifty. Bank Nifty is up 1/3. Mid and small cap indices are up tentative, but 0.5% of the 0.5% odd there as well. It's a wrap on Bazaar from all of us here. It's goodbye. Thank you for watching. Chartbusters coming up next. Stay tuned.